All right. What up, everyone? Welcome back to Financial Education. Let's see if I can get the system back working. Display, work, video capture. Cool. Video's working. Hair is looking crazy. All right. We are live. All right, let me just make sure the sound quality is good. All right, so let me move myself over here. Cool. Getting there, getting there. All right. So, what's going on in the market today? Let's check it out. Cool. So, mic check. Check the mic. Mic looks pretty good. Let's get a summary of what's going on, and then I will go. Okay. So, live. Geez, technical difficulties every time. I have to fix that. Cool. What's going on in the market? So obviously the market dumped today. It was a dump. It's another day of dump after another day of dump, and it is not too exciting at all. As you can see, the Dow has been down, S&P, Nasdaq, Russell. I mean, everything's getting beat up, and we can see the Dow and the Russell are really beat up a lot here. As you can see, Russell down almost 2% on the day. 5 day straight 5% down past month. They were down about 5%. Past 5 days, 5%. Past month, past 6 months, the Russell's up 11%. That still is pretty good. Year to date, about 5%, and then about 1 year performance, we are seeing the Russell do about, what is this? We're looking at 1.5% in 1 year. So not a crazy amount of movement here. And if we go back and we look at the price here in 2021, we're sitting at 22. So it looks like it's trying to hit this 22. This could be a major support line. A lot of people are going to start looking at once the market once the price starts continuously just dropping. But today's biggest news, so Fed rate cuts hope decline amid mixed economic signals. So financial markets have grown more skeptical about the December rate cuts for Federal Reserve, with trade indicating that reduced likelihood of such a move. This follows a hawkish comments from some Fed officials, and mixed economic picture emerging after the end of the government shutdown. Market sentiment shifts significantly on Friday, reversing earlier decision in favor of rate cuts. Um, the Dow, Nasdaq, um, and futures edge higher after Dow's sharp drop today. Um, let's dive deeper into it with AI. Let's just see. Let's get a summary actually using Gemini. So, what moved the market today and major uh, news around the stock market and economics? So, what actually happened? So major indices fall as we saw the S&P, the Dow, like everything today. All the indices are falling. As AI tech stocks under pressure. Companies tied to AI, like Nvidia, they've declined about 2% today, which is insane. As investors trimmed position on this stock, as well as Peter Thiel and a whole bunch of large investors have decided to trim their position and move on to like companies like Microsoft. Um, but we've seen, a long time, really good investor like Warren Buffett come out and make probably one of his last purchases in Google. Computer hardware sell off, so shares of Dell, uh, Hewlett Packard, Packard Enterprise, and HP falls sharply about 7 to 8% after Morgan Stanley downgrades them, citing uh, rising memory chip price that could squeeze their profit margins. Big Short, Alphabet, Google shares of Google parent company Alphabet jumped 3%, leading to gain on the S&P after Warren Buffett discloses that he bought some shares. And once again, it wasn't that much. Google, Warren Buffett didn't buy that much. I think it was about $15 million of shares, which really was not that much at all. So boom, boom, boom. Let's see how many shares did Warren Buffett buy. This Warren Buffett buys Google here, investing about 4 million. Looks like 4 million right here value. So that's not a lot of money, and this is a company that has over $300 billion. So portfolio value of almost 300 million, buying something that's $400 million worth of Google. It's not, it's not anything that big, but it does tell you Warren Buffett sees some kind of value in the company. So what else do we have here? We have Big Short, major economic news. So the biggest catalyst, Nvidia earnings are coming up on Wednesday. This is going to be a big earning. I think depending how they report, Nvidia reporting can take, like, literally crash the market. If the numbers don't look good, it is going to be a hell to pay. And it is not going to be good at all. And it's going to be really scary. The market is hoping that Nvidia comes out with really good numbers, and I'm sure that the government is going to be looking at these numbers and really hoping that Nvidia reports really good numbers. We have sorry, I'm a little distracted. Delayed U.S. job reports Thursday, so the first full official labor market snapshot for September will be released because we're not getting October data, finally ending a long-dated drought caught by the government shutdown. Investors are anxious to gauge the health of the labor market and its implicit implications for the Federal Reserve. Retail earnings or results from major retailers like Home Depot, Lowe's, and Target are also due this week, providing the first major clue on the strength of the U.S. Economy. Because what happens is Home Depot and Lowe's, I think Wednesday, Thursday, these companies, Home Depot's Thursday and Lowe's is on Wednesday. These these companies tell us like what are people doing? Are people buying homes? And when they do, excuse me, are they investing? Are they investing um, in are they investing in repurchasing home improvement products from Home Depot and Lowe's? So usually this kind of indicates which way the market is going. So this is used as a good indicator of where the U.S. Consumer is. The Federal Reserve rate expectations. So the market is wrestling with mixed signals from the Federal Reserve official regarding the path of interest rate. Comments from officials over the past week have led traders to significantly lower the probability of December cuts down from 70 to 50%. Inflation concerns, consumer concerns about persistent inflation and the central bank's next move continues to pressure risk assets. So one thing about this is Trump, I believe, is working on a bill that will lower tariffs on a lot of countries that we buy a whole bunch of our goods from. So this will probably help that. Um, and so if that bill passes, I think it's going to be pretty good there for the economy and goods, and this could move the market to the upside. Other noteworthy headlines like crypto. Bitcoin extended its recent losing streak, dropping its lowest level since April, which weighed on related stocks like Coinbase, Robinhood, and SoFi. Kraken, obviously, Kraken is still a private company, so we can just say we can say a company like mm, I can't find their Q4, but there were some publicly traded crypto companies. I mean, obviously, it's Michael Saylor's company is not doing well. Tom Lee's company, BMNR, also didn't perform well just because of what happened in the market. Um, you got Japan's GDP data shows Japan's economy contracted in the third quarter, adding the global growth concerns. And Japan has printed like a couple $100 billion in this case. Ended the U.S. government shutdown. Senate passed a spending bill to end the government shutdown, at least for the moment, extending funds through January. While positive, the market remains focused on the deluge of delayed economic data that will be released soon. So this is some of the stuff that moved the market, and we can see that crypto has been getting hit. Um, as you can see in the past 7 days, the Bitcoin is down about 5%. Um, Trending. Let's go top. So Bitcoin is down. Sorry, 7-day percentage movement. Bitcoin is down almost 16%, 15.46%. Ethereum down 18%, and then you got the alts like XRP down 16 as well. BNB down 16. Solana down. Doge, the speculative plays are down. Um, you also have companies like Hyperliquid that is allows like a lot of leverage plays also down, but doesn't look like past 7 days it's been beat up as much as all the other companies, which is pretty crazy here. Um, but overall, the company, the stock has been down. The market cap is really come down from 15.9, about 573 million market cap, now sitting. Oh, well, that's not right. About $16 billion market cap, now sitting about 13. The price of this crypto is also down from $47 to 39. Listen, compared to a lot of other cryptos and how they're doing, it's not beat up. Past month is still up about 8%, a little over 8. Past week down 5%, and past day 24 hours is up. It's up about almost 3%. So this market is kind of saying maybe this is the bottom for the bottom is in for Hyperliquid. Zcash, this thing went up to like 750. Today is, I mean, overall is down in the past 24 hours about 16%. Past week still up. Past month over 170%. Not long ago, this thing was sitting at $47, and now we are sitting at $601, which is pretty impressive to see for this cryptocurrency that is more of like being able to move your money around without anybody really knowing. So um, Chainlink, I mean, this one is down 21% almost. Ethereum is hitting lows as well at 18%. Um, I think the best place to look at these is probably TradingView. Trading TradingView changed the logo. That confused me. But yeah, just the overall market is really is just getting beat up, and who knows when we're gonna recover in reality. I think the market is waiting, like they were saying, for the government to release those numbers, and so that's gonna really paint a picture of the best direction for individuals and institutions to start investing in the stock market. Crypto. Let's go look at crypto. Coin market cap. Let's go BTC USDT. Let's launch the charts. Let's check out the charts, and then after this, we're gonna go react to what's going on with coin, CNBC, and the overall news for the day. So as you can see, this is Bitcoin. I mean, we're looking at the 1 minute, but let's zoom out to the 1 hour, and it's just dumping, dumping. It is. This is a thing that was sitting at about 120, 25, and from there we've just dumped about 27%. Actually, a little bit more than 27. Let's go to the peak to where we're sitting right now. That's about 29, almost 28, a little bit over 28%. So that's a lot of movement. We're gonna watch a video on the technical analysis of Bitcoin and cryptocurrencies and see where we're going. It seems like it's two different directions. Some are saying, this might have bottomed. Others are saying, you know what, this definitely is not the bottom. We're gonna go down even further. I drew this like a long time ago, and somehow there's some kind of respect to this chart. Not fully, but there is a little bit. As you can see, we are sitting. We kind of see consolidations around these lines, around this line. So maybe there might be some chance that we can come down to this 80, if not more going forward. So that's where Bitcoin is right now, sitting at the price of $90,000. I mean, this is a crypto that was sitting at over $120,000 just not long ago, and it just keeps dumping. And this dumping because investors are not interested in sitting in something that is so high risk. Um, in a way, there's a lot of relationship between cryptocurrencies and um, what's going on with tech. So when you see the Nasdaq drop by 1%, I mean, it seems like crypto is leverage of the Nasdaq, 2x whatever Nasdaq is. So that's why we're seeing like significant liquidation here, just because a lot of investors were hoping crypto is gonna go to 200,000-300,000, but to probably $200,000 by the end of the year, and they were hoping that Ethereum would also go to new highs. But from what we're seeing, Ethereum's getting beat up just as much from top to bottom. ETH hit almost 3,600, and to where we bottom today, that's about 19, a little bit over about 19% decline from. Nope, that's total cap. Let's zoom out even more. So ETH at the top is about 49, so almost hit $5,000 to where it's sitting now. It's sitting at 2950 about, and so that's a good 40% decline on Ethereum from the top, and that is a lot on this crypto. Just imagine how much money is getting liquidated here. Is it billions and billions of dollars? So obviously a lot of these lines I drew out a while ago, and there's moments where Ethereum kind of bounces off of these, comes down, bounces, but in this case it really went below this, came back up, and I actually drew this today just because I wanted to see what's going on, but it looks like we're going down. I mean, we can go up to like 2,500 on Ethereum, if not more, if Bitcoin continues to go on this downtrend. I'm gonna let the professional technical guy kind of show what's going on, but overall, the market is really getting beat up. So let's watch what is going on here on CNBC. Let's react to a couple of videos, and then we'll go from there.
The most important event of the week, maybe of the year, are NVIDIA's earnings. They're out Wednesday afternoon, and to say they are a big deal is an understatement. So we brought on two big deals to talk about it. Gene Munster, Managing Partner, Deepwater Asset Management; Dan Ives, Global Head of Technology Research at Wedbush Securities, both coordinating and rocking some pink today, by the way. So appreciate that. No, it's my race car helmet is pink.
I think Gene wearing pink's bullish.
Yeah, this
too.
is a big deal for me. Usually
Pink is now the bullish color. Let's talk about this, Dan Ives. How big are NVIDIA's earnings on Wednesday night?
It's a Super Bowl, not just for tech earnings, but I think this market, right? I mean, the reality is that there's only one godfather of AI, and that's Jensen. And NVIDIA, look, it's the foundation in terms of what demand looks like, in terms of what we're seeing. And Gene and I talk about it often. I think it's going to be actually a huge positive growth catalyst that we see, not just for NVIDIA, but for tech stocks. But it all comes down to on Wednesday night, you're going to be able to hear a pin drop on trading floors around the world.
I just don't know, Gene, how you even plan for this. Normally, you've got the analyst estimates, you've got a little bit of a whisper number. If they kind of come in a little bit above it, it's good news. Everybody knows NVIDIA's numbers are going to be gigantic. Is that a fair statement?
Yeah, it's not only a fair statement. Back on the 28th, Jensen went at the GTC. He basically gave us the playbook through the end of next year. He said this $500 billion in Blackwell and Rubin revenue. If you take that for his word that they're going to be able to do that, now if they can get supply, that implies a 54% revenue growth rate for next year. The street's at 41%. Now it's come up from 34 to 41. But that's the gap, as I think about this, Brian, that's the gap between where they've set the bar on the 28th.
He gave us 54% revenue growth. I don't know a lot about Wall Street, except I do know this. 54% ain't going to do it when it comes to the stock. It's going to have to be better than 54%, isn't it?
I don't think it needs to be better than 54 this week. I think it needs to be better than the 41 where the street's at.
Yep. And to Gene's point, look, we're getting back from Asia, being there 3 weeks. Demand to supply for NVIDIA chips is 12 to 1. So it comes down to there's one chip.
12 people want to order for every one potential chip that exists to order.
So there's one chip in the world fueling the AI revolution. And that's why it speaks to our view that anyone that talks, and Gene and I talk about it all the time, anyone talks about an AI bubble here, we are in the third inning of where this is all playing out. And I think that's why this is an inflection point. You're going to see ultimately what the demand looks like from Jensen himself. And I view it as a bullish catalyst for tech stocks.
Here's the worry, though. Again, not a tech expert like you guys, but I do know also that technology changes. It evolves. And I think, Gene, if I was, now I guess I have to play the role of the bear-ish, right? Mm-hmm. If I was going to be the bear, I would say that what if somebody else comes out with a much better chip and all of a sudden NVIDIA's chips aren't as good as they are right now?
Well, that's I just don't think that's simply even in the equation, or at least over the next 6 quarters. But to your point, maybe 2-3 years down the road. And that's, I think, probably the biggest takeaway that your viewers should glean from this week is that we're still early in AI. Now, the companies that benefit from that will change over time. They'll kind of have 2-3 year chapters of growth rate. But I think that the undeniable truth here is that we have just scratched the surface in terms of where this is all going. And when I hear talk about Peter Thiel selling or SoftBank selling NVIDIA stock, I think it lands on something where they've made some money, but I think ultimately we're still so early, and there's going to be a lot of companies that are going to benefit from this over the next several years.
Join us now with more on the crypto market. John D'Agostino, Coinbase head of institutional strategy. We've seen this movie before. What was the biggest sell-off? We had a move from I think 65 down to 15,000, didn't we? At one point with Bitcoin.
Sure. I mean, so historically, Bitcoin has traded in these 4-year cycles, and so we saw 2014, 2018, 2022 material moves down.
20,000 down to 3,000 at one point, I think.
Absolutely, yeah.
So it can lose 70 or 80% of its value and then only to see new highs again.
So generally, after those down years, we've seen 2 to 3 years of up 150, 160% returns.
So what do you, what would not, is it less volatile now? Or are the sell-offs going to be not quite what they were, or is it possible? Let's see, 125. Could it go down to 60,000?
So mathematically, it is becoming less volatile. Just as a strict standard deviation calculation, it is becoming less volatile. You would expect that as you have a wider and deeper market. You have more different types of investors. Obviously, the ETFs have brought in a flood of retail. You have more institutions. Harvard Endowment announced they hold more Bitcoin than gold the other day. So mathematically, that's what you would expect. It doesn't feel that way, to be very honest, right? The sentiment is brutal right now, and you have to be very, very honest about that. Just like I'm sure, you're holding gold, you feel smart. You didn't feel so smart in 2008 when gold lost 1/3 of its value.
For years and years and years, you just felt average.
You feel smart.
Yeah.
Right. So, as we've said many times on this show, trying to market time any volatile asset can get you in a lot of trouble. If you've systematically invested in Bitcoin over a 5-year period, you're up an extraordinary amount. Even year to date, while not great, both Bitcoin and Ethereum, while slightly negative, Ethereum's a little bit up. If you stake your assets, you can earn a higher yield. So you're still net positive. Solana's down materially for the year, 25%, year on year, 41%. However, we had the single best ETF launch of the year for a Solana ETF. So in these situations, I try to step back and ask myself, what has fundamentally changed since, let's say, late September, when everyone was incredibly bullish? And the answer for me is nothing. Structurally, we're where we were, if not better. We have the Czech National Bank announcing a central bank Bitcoin purchase, the first Eurozone country to do that. You've got Citibank and JP Morgan announcing stablecoins that they're using to facilitate customer transactions. You've got Harvard Endowment's announcement. You have successful ETF launches. So it's a challenging environment currently, but in my house, we like apples. I don't like apples less when they're on sale. So if you like this asset, you should like it at a discount.
What if you didn't like it in September and you like it now? Should you like it now at a discount? Because price does matter. I know you're sort of suggesting, you're suggesting prices don't matter at all.
If you like it because you thought it was overbought, of course. If you didn't like it because you thought it was overbought, yes. If you didn't like it because you don't agree structurally, probably not.
No, I'm just saying, right, like sometimes, avocados go up and down in price. You may love avocados, but you may say, this is a little rich for my
Sure.
The price tag's a little high right now. I'm not going to buy the avocados, but you know what? Sure. The next time I walk into the market and the avocados that are a better price, I'll take some.
So you're a technical avocado trader in this example, and that makes perfect sense. I would expect technical traders would be buying into the mean reversion trade at this point. So that's kind of why I'm a little bit confident. Again, structurally, I don't see a regulatory environment in the U.S. or globally that is any worse than it was pre-October 10th.
What did you make of, and I've been asking the question a lot just because I remember being sort of surprised when she first said it. Cathie Wood made a very interesting point. What? It really did.
Really not.
Well, I know you don't
To
agree.
go
but
from 1 point.
Hold on, just
for one thing, to have a price target of 1.5
to the audience what
to
we're
have a
gonna-
price target of 1.5 million
Okay.
is ridiculous to start.
Okay.
To go to 1.2 million.
It doesn't even matter. That's not the point. Let me explain.
You know what he's doing.
I heard you
No,
after.
the point is slightly different. The point is that she made an argument that she was surprised about the success of stablecoins and how she believed that stablecoins, to some degree, could crowd out some of the Bitcoin trade because people are going to use stablecoins more for transactions and the like than she originally thought. She thought Bitcoin might be used more for transactions than they will be, and that was a surprise to her. Forgetting about
So it's only going up 15 times
Forgetting about
from
her
where
price-
it is now instead of
Forget
20
about her price
times.
target. You're focused
Instead
on
of
the price
20
target.
times from where it is now.
Okay.
Both
I'll just be
both
quiet.
predictions are ludicrous, right?
So I wouldn't say ludicrous. I think Kathy's an incredibly brilliant person, and I trust her judgment. I heard another one of your guests, I think it was Michael Saylor, say that they didn't see the direct correlation between
20 million, isn't he, or something? What's his target?
at some point in the future, right? I'm not sure I see the users of stablecoin substituting that long-term asset for Bitcoin. And I'm not sure I see the people who want to buy Bitcoin as a unit of currency viewing a stablecoin as a surrogate for that. So I'm less confident.
Andrew,
in that.
for you,
Hey traders, in this video we're going to
I don't know if I can agree with that. Like, I do kind of see room where Ethereum does become more of that stable coin, and is going to be supporting that. So at the end of the day, I think it seems like there's going to be a lot more transaction going on Ethereum. So that's why I think Ethereum is going to most likely win. Because imagine Google, they have, so Google has a product, and that product is people go on there and make websites, websites and different platforms like YouTube and so on and so forth. And so because of that, there's so much more network activity. And I would think that the companies or the blockchain that has more network activity is going to be worth a lot more. If Bitcoin is just going to be sitting there and just holds your asset, and maybe I don't know what kind of network activity that is providing, and then people have to mine it, the value of Bitcoin is only going to go up because the whole idea of store of value, not because it's a network, like gold, for example. There's a whole bunch of products that people can make with gold, and so because of that, gold has its value. So what types of products is gold used in? For example, phones is one thing that gold is used in. Okay, let me zoom out. So deep dive, let's see if that came up. What type of product? Gold is used in a wide variety of products, from everyday electronic devices due to its properties of excellent electrical conductivity. So because of that, gold is used in all of like electronics, aerospace, automotive, glass making, and catalysts, gold nanoparticles, medical devices, dentistry. So the list goes on and on and on. Gold is used in a whole bunch of products, so that gives it value. So if Bitcoin becomes this like custody and holds money for people, then it will have that custody value. But the one that creates the most network activity is going to be the one I think that's going to do well. So from an activity perspective, I think Ethereum seems to be the appropriate chain here. So I can see why Kathy would believe that. So I think maybe there's something there that some investors are not seeing, and that might be the alpha. ETF Edge on Bitwise, Explosive, Solana Stake ETF. There's a whole bunch of ETFs actually right now kind of tumbling, not doing as well as not as doing as well as a lot of people expected. BMNR, for example, is a stock. BMNR is a stock that people were hoping that it's going to do well, but we don't see it doing too much. I mean, it's actually down significantly over the past couple of days. So one day, just in one day, the stock has moved down 10%. In the past 5 days, it's moved 24%. In the past month, it's moved down almost 38%. But in the past 6 months, this is also a stock that's up 867%. So overall, it's up significantly because it was announced that they're going to buy Ethereum. And they seem to have a pretty good strategy on how to, get themselves to start buying Ethereum. But at the same time, we're seeing the value of ETH drop significantly. As you can see, Ethereum is sitting below the 3,000. So 2,957. So this scares investors. They're gonna obviously close out anything that is that's underlying that. So I mean, a lot of these like Bitmine and microsailors, crypto ETF also not doing too well. Sharp Gaming also not doing well. Like I share Ethereum, a lot of the Ethereum funds are also not doing well. But let's watch this. ETF Edge and Bitwise exposure to understand the ETF with Tom Lee Red Shots ETF.
Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm Leslie Picker in for Dominic Chu. Bitcoin hitting a death cross this past weekend after closing out a third consecutive week of losses on Friday. The other major cryptos following suit with similar declines. Is this a red flag or maybe even a green one to buy? Joining me now is Thomas Lee, Fundstrat Global Advisors Managing Partner, Head of Research, and a CNBC contributor, along with Matt Hogan, CIO at Bitwise Asset Management. Thank you both for being here. So let's just start broadly with your kind of high-level view here. What do you think is really going on? Tom, let's start with you first.
Well, Leslie, I think the markets are a bit nervous in crypto land, in equity world, because one, we've had a government shutdown, and then there's been doubts about AI valuations and people raising questions about that. So AI stocks have corrected and many growth stocks have corrected. And then in crypto specifically, it's been dealing with two issues. One is there was this big liquidation event on October 10th, one that really was a larger liquidation event than anything seen in history. And the second is because crypto is risk on, I think markets are really struggling with what the Fed's going to signal on December, because, if you end up with a hawkish Fed, it gets crypto investors very nervous. I think that's all creating this downside pressure, but I think the good news is there are signs of exhaustion. I did speak with Tom DeMark of DeMark Analytics, and he thinks there are signs that would look like a bottom that could be occurring sometime this week.
Matt, do you agree with Tom here?
I actually do exactly agree with Tom. I think we're nearing a bottom. I look at this as a great buying opportunity for long-term investors. Bitcoin was the first thing to turn over before this broader market pullback. It was sort of the canary in the coal mine, signaling that there was some risk in all sorts of risk on assets. I think it'll be the first thing to bottom, and I agree with Tom. We're getting very close to that point. So I think it's an exciting opportunity, again, for people who are looking out a year or more into the future.
Tom, kind of digging into Ethereum a bit more, what do you think are some of the idiosyncratic drivers here? Are there things that you think may be due for more of a decoupling from just the broader risk environment or crypto as well?
Well, Ethereum is a smart contract platform, so it differs from Bitcoin, which is a store of value, and in many ways its virtue is that it's inert, and it represents digital gold and a good store of value. Ethereum, on the other hand, is because it's a smart contract platform, is really the rails where I think a lot of things are going to be built. And one of the big breakouts this year has been stable coins, but it's also been things like prediction markets, and now talk about tokenizing more than just dollars, but equities and real estate and alternative assets and other assets. And a lot of that will be built on Ethereum or layer 2. So I think from a perspective of what the ecosystem looks like, Ethereum is a place where there's a lot of activity taking place, and you can measure it by transaction volumes or transactions per second or even value locked on the chain. And these are all rising. So to us, I think it's a story that still is in the earliest stages, and one of the reasons we consider it a super cycle.
And Matt, you agreed. You said that you agree with Tom that it's nearing a bottom. How much of a long-term buy do you think this is?
I think it's a generational opportunity for long-term investors, whether you're looking at Bitcoin, Ethereum, or Solana. To double down on what Tom said about Ethereum specifically, look, I think investors are very nervous broadly about the economy, about AI valuations, about tariffs, about the broad economy. You want to look for secular trends that are decoupled from that. I think regardless of what happens on the economy in the next year, stable coins will grow tremendously. I think regardless of what happens, tokenization will, maybe 10x in the next few years. Prediction markets are going to be huge. Decentralized identity and digital identity are going to be huge. Ethereum lets you play those secular trends, which are in this enormous growth phase, almost regardless of what's happening in the broader economy. So for me, it's really it's a generational opportunity, and to get in at these prices, I think really is almost a gift for long-term investors. It's a tremendous opportunity.
What seems to be the problem, soldier?
The belly's full of Greeks. Innovation changes everything.
Send it back!
One ETF, 100 innovators rethinking the world. Before investing, carefully read and consider fund investment objectives, risks, charges, expenses, and more in prospectus at Invesco.com.
Tom, in terms of just the overall volatility, what are some of the near-term headwinds you're expecting Ethereum to face?
Well, one of them is the industry did suffer a big liquidation event that I think crippled many players and wiped out many accounts. So I think that this, just like in 2022 or in 2020, it does take a few weeks for the industry to sort of find its footing. And I think that's why crypto prices have lagged here. And it does have the signs of that maybe a market maker or two actually is unable to provide market liquidity. And as you know, as liquidity contracts, it's the same thing as the central bank tightening. So it's almost like crypto QT. I think the other thing the markets are grappling with is people talking about the 4-year cycle. Many are convinced that Bitcoin prices have peaked. So in some ways, Bitcoin being the blue chip and the bellwether is important for crypto, because if Bitcoin makes a new high this year, then it really obviates the fact that there is a 4-year cycle. And so it's, to me, between now and year end, I'm pretty bullish on stocks. This sort of weakness in the first half of November was what we expected. But as markets rally, I think that's going to help propel Bitcoin to an all-time high.
Yeah, and to your point about liquidity too. Matt, switching to another crypto, your recently launched Solana ETF attracted $420 million in its first week, according to LSEG data. But you took a slightly different path to market to be the first mover in that area. Can you explain your process?
Yeah, absolutely. I mean, in short, the government was shut down, but just because the government can't get its act together and move forward doesn't mean that ETF issuers have to stop what they're doing as well. So because we were far along in the process of developing that ETF, we were able to, effectively go auto-effective after removing a piece of wording in the prospectus. That let us launch despite the government shutdown. It became one of the most successful ETF launches of all time. BSOL is the ticker, as you mentioned, almost $500 million of inflows. And I think it speaks to the incentive and pace of innovation in this ETF crypto ecosystem. There's a huge demand for high quality crypto ETFs. If you can be first to market, investors will respond to that. And we've seen that with Bitwise and BSOL. We saw it last week with Canary with their XRP ETF. There are a few more that are coming down that pipeline. So it was really just not letting the government shut down, slow us down at Bitwise.
Yeah, certainly a scarcity element perhaps as well at play with very few ETF launches and then being able to obtain all those inflows. Now, obviously, the government is reopened, at least temporarily. Tom, what are your thoughts on the current regulatory environment for crypto? Do you feel like 2025 saw a real watershed moment?
Oh, absolutely. The regulatory environment for crypto has gone from one where the previous regime was essentially extinguish any activity related to crypto, and if any entity was involved or even touched anything in crypto, you could be sanctioned, to one where experimentation and innovation are being encouraged by this administration. So I do think it's actually the right regime that's in place, because as you know, the race that's taking place over the future for any country is not only innovating on digital finance, right, moving money digitally, but it's really also taking the leadership in AI. And in so many ways, especially in an agentic world, crypto and AI actually are going to be working side by side. So I think leadership for crypto and AI are part of any nation's leadership.
Matt, how do you see crypto ETFs evolving in 2026?
It's going to be ETF Palooza in crypto land. I think there'll be 100 plus launches. We're going to see a lot of single asset crypto ETPs. What I'm most excited about, though, is the growth of index-based crypto ETPs. If you think of who is the next buyer of crypto, it's someone for whom crypto is a small part of their portfolio. They don't necessarily have an opinion on Ethereum versus Solana or Bitcoin versus another asset. They just want to buy a broad swath of the crypto market and hold it for the long term. So I'm excited about launches like Solana and XRP. There are a few more that I think will be really great. I think Chainlink will be an amazing launch. There are others coming down the pipe. But index ETPs, I think, will be one of the biggest stories of next year in crypto.
All right, so you spoke about Chainlink. So I've noticed, Chainlink has been getting really good institutional adoption lately. And this is a crypto that's down significantly. So looking at Chainlink here, Chainlink is definitely down over 20%. Just today, down 4%. Past week, almost down 20%. However, if we look at who are the partnerships that Chainlink, what large institutional banks use Chainlink crypto, there's actually a significant amount of institutions. So SWIFT, the global provider of security financial management services, has partnered up with Chainlink on several initiatives. In a 2025 pilot, SWIFT and Chainlink, along with institutions like UBS, demonstrated how banks could access blockchain using existing SWIFT messaging infrastructure via Chainlink platform. JPMorgan Chase, the bank's blockchain division, Connexus, has used Chainlink as an orchestrator layer to enable transactions involving tokenized assets in public blockchains. In 2025 transaction, JPMorgan utilized Chainlink to settle purchase of tokenized treasuries. UBS, through its tokenized arm, UBS tokenized, the bank has conducted tokenized funded transaction using Chainlink. Chainlink's digital transfer agent standard. BNY Mellon, the financial service company, has collaborated with Chainlink and SWIFT to test blockchain interoperability for tokenized asset settlements. ANZ, Citi has participated in pilot alongside Chainlink and other institutions to test interoperability of tokenized assets across blockchain. Fidelity and Goldman Sachs. So as you can see, like the number of institutional banks that are long, a lot of these blockchains are up there, and so that's why it seems like an inflection point. While President Trump has been in office, it really has been an inflection point, and the way that the traditional finance TradFi is seeing blockchain and crypto. So Chainlink seems to be the next one of the next cryptos that is really partnering up with a lot of institutional companies out there. So I like Chainlink. The fact that it's down 20%, it's not a bad day to pick up some Chainlink if you're interested in that crypto. Next, let's continue listening to this, and then we'll go from there.
Categories by which people invest. Of course, Bitwise has been running index funds for 8 years, so I'm speaking my book here. But I do think it's how the dominant way most people will want to invest is just owning a basket of these assets and betting that in the future, this industry will be 10 times bigger than it is today.
It seems that the gladiator is getting a lot of.
Wow. Yeah, well, 100 new launches next year is no small number. Tom, we can't let you go without asking about Granny Shots. That ETF recently celebrating its 1-year anniversary, gathering $3.6 billion in assets in its first year. You plan to expand the lineup. How do you plan to do so, and where else on the court will you be shooting from, so to speak?
Yeah, well, that's right. Granny Shots, which refers to a way of shooting free throws, proved to be very popular with investors, as you point out. And part of it is the performance. Granny Shots, in its first year, outperformed the broader index by 1,000 basis points, and year to date, beating the S&P by more than 1,000 basis points. The idea of Granny Shots is the idea that there are super cycles, themes that last for more than 5 to 10 years, and we want to buy the strongest stocks. So we are expanding the Granny Shots family, that they're going to go effective tomorrow. One is a SMID cap Granny. So this is taking the same Granny model, finding the 7 super cycle themes, but buying small and mid cap stocks. And it's going to hold more names, maybe 40 to 50 names versus 30 for Granny. And this is going to be a good way for investors to get additional Granny exposure in small and mid. And the second is an income-oriented Granny Shots product. So this is going to be using the same Granny Shots model, but also generating income. So the tickers are GRNJ for small and mid cap, and GRNI for the Granny income.
Well, it's good timing to have you on then, right before that launch. Tom Lee, Matt Hogan, thank you.
Okay, so I thought this was, so here is what the Granny Shots, so this is what they hold essentially. So this is Tom Lee's ETF, large cap ETF here, Granny, which hold like Tesla, Alphabet, CrowdStrike, Palo Alto, Caterpillar, Robinhood, Oracle, and Lamar Research. And it says it is important to note that the Granny Shot strategy focuses on identifying key themes in the market with stocks that fit multiple themes being included in the fund. Kind of like think of it as the direction of where the economy is going and what's popular in the next 5 to 10 years, and then he kind of invests in that direction. The portfolio is rebalanced on a quarterly basis, and so holdings in the portfolio can change. The most up-to-date holdings should be confirmed via the official website, blah, 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 blah. So here's their holdings. As you can see, Tesla had a decent day today, up about 1%, and then also Google had a good day just because of Warren Buffett's Berkshire Hathaway was able to invest a little bit of their money. In essence, it's like if you had the amount of money that Warren Buffett really invested is equal to you having $100,000 and you decide, you know what, I'm going to invest, let's say $1,200 or $1,300 to buy some shares. People think that's a lot of money. To a lot of people, that is a lot of money. But when you look at it as a percent of their portfolio, that's not much money that they're investing. But the fact that you're seeing, a Warren Buffett who's really has outperformed the market and just been an amazing long-term investor who has done amazing, kind of tells you maybe there is something here. So people look at it a little closer. So you can go back and look at my channel. I've posted multiple videos on Google. Google is a pretty awesome company. So I think they really serve like the U.S. economy. And like if we're to think about like how many people does Google employ, including YouTubers, it is insane to get like an approximate number, right? So as of September 30th, 2025, Google's parent company reported a total of 190 employees. The figure includes all employees across its various businesses, including Google, YouTube, and other ventures. While the company does not typically break out specific headcounts for each subsidiary, the numbers represent the total workforce of the entire organization. So 2024 was 182,000, and the total number of employees were reported to be 183.3 thousand at the end of 2024, showing a slight increase of about 182,000. And then, as you can see, as of September 30th, 2025, they have 190. And the number of people working and becoming YouTubers and making content, that number isn't slowing down, right? Not slowing down at all. Next, we're gonna move on to the Bitcoin. We're gonna look at where Bitcoin is, where we're seeing the technicals, and just the overall direction. Ethereum Bitcoin crashes. Are we doing it? This might be a good video to look at later, but right now let's go watch this video here. Benjamin Cohen, he's really good at doing technical analysis. He has an entire platform built for this, which is pretty impressive. Into the Cryptoverse is a pretty cool platform. I haven't used it, but I've seen him using it and interacting with it. It really helps you break down technical analysis around crypto and break it down in so many ways that will, if you're a technical analyst, it kind of helps you understand where we are in this cycle. So let's go look at this and then we'll go from there.
Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin. The bulls versus the bears. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium off views. It's really easy to get sucked in to only one view with no way to see the other one, but at times it's useful to say, look, let's go through why do people believe the market is bullish and why do people believe the market is bearish? And once you can understand both views, then we can start to have a more reasonable discussion on what that means, and maybe we can even construct a potential outline for how the price action might ultimately unfold. At the end of the day, you know, there's a few things we must remember. And one of those things is that there is not a single person in the world that knows exactly what's going to happen in the markets. It doesn't matter how confident someone appears or how boldly they say something. At the end of the day, no one knows. We're all guessing. Some people are better at guessing than others. Some people get luckier than other people. But at the end of the day, no one knows. And so when you kind of come to that realization, it makes it worthwhile to look at the price of Bitcoin through both the bullish and the bearish lens.
Scribe is how you stop explaining the same.
Here is where it gets tricky and why it feels like the cycle, it leaves something to be desired. Because every prior peak was accompanied by something that we don't have right now, and that is euphoria. There has been no real euphoria in the crypto markets. In fact, one of the things that I've said before for the S&P 500 is one of the topping processes you look for is when the price hasn't really moved for a year. Now, we're sitting here we're talking about that for the S&P 500, but then you can't start to notice that for Bitcoin, the price is where it was 1 year ago. And so the reason why the price kind of sitting at the same price for a long time while it kind of can lead towards tops is because the bulls just get exhausted, right? Like the dip buyers get exhausted, you know, and the same thing kind of happened last cycle, where after so much time of buying and price not going higher, eventually they give up. And if the buyers get exhausted, that can lead into the midterm year bear market. But what are we missing again? We're missing euphoria. And no prior 4-year cycle top has occurred on apathy. Now, you might say, well, Ben, Bitcoin has never topped on apathy, but it actually has. It has topped on apathy one time. And it's the example we have given the entire market cycle to say, look, guys, we are not in the 2020 style rally. We're not in the 2017 style rally. We're not in the 2013 style rally. We're in a rally that's comparable to what happened in 2019. And the reason for that is based not around the halving, not around any of that stuff, but it's based more so around monetary policy. What time in Bitcoin's history is the most like this time when viewed through the lens of monetary policy? It's 2019. There's something on the website, the Into the Cryptoverse website, called the social risk. Think about it as social interest. And when there's no interest, it's color-coded dark blue. When there's a lot of interest, it's color-coded dark red. So if you hide it all and you only look at anything above 0.8 and anything below 0.2, what do you see? You see that this entire cycle has been simultaneously going on during a period of apathy and relative disinterest. No one really cares that Bitcoin is trading at $94,000. Right now, to say that Bitcoin is trading at 94K sounds like a bearish thing. But when you think about the fact that Bitcoin was trading at 15K exactly 3 years ago, this is a great return, right? I mean, Bitcoin is up from the low, even at this point, 500%. Any investor in the stock market, that would be incredible, right? Even if you were to take profits now, if you bought at the lows, that is still a 500% return. That is a 6x move off the low. For comparison, the S&P 500 from the low is up 92%, not even a 2x off the bottom. The NASDAQ, which has done remarkably well from the low, is still only up 138%. So Bitcoin gets a bad rap in bear markets for going down 70%, 80%, but people will conveniently ignore that it significantly outperformed stocks to the upside for years. And so what if it gets deeper corrections in bear markets? If it goes up 800% in a bull market, it should be allowed to drop significantly in a bear market without labeling it something that's never going to recover, or labeling it whatever you want to label it to make yourself feel better for missing out on it for the last 16 years. So if you look at Bitcoin and you're sitting there like, oh yeah, see, I was right, just know that the bear markets for Bitcoin are normal, right? Like they've happened every 4 years, all through Bitcoin's prior existence. And so if we have a bear market in 2026, and we're potentially kind of framing it now, like, you know, in the topping process, it's normal, right? Like it's normal. It doesn't mean that Bitcoin is going to zero. It's just a reset period. Now, the hard part, again, is that how can we say this is the same as 2021 and 2017 when we're so apathetic? It's because it's more like the 2019 rally and subsequent disinterest. It's more like that than any other prior 4-year cycle top. But what it leads people to say is that because there's no euphoria, this time is different, right? And therefore, the argument is that it'll go on into 2026. Guys, no one knows what's going to happen. We are a product of our experiences. It's basically like, you know, several years ago in early 2022, when I said that, you know, Bitcoin dominance was about to enter a massive uptrend. Why did I say that, right? It was because I knew from prior experiences what happens to altcoins during periods of tighter and tighter monetary policy. And I knew from experience what happens to altcoins when Bitcoin dominance is very low. They then start to bleed to Bitcoin. So because I experienced that, I was able to say confidently, guys, look, this is what's going to happen again. If you didn't live through the 2018 bear market and live through the 2019 bull market where alts bled to Bitcoin, you might have assumed that Bitcoin dominance going into this macro uptrend was not really a strong possibility. But it happened anyways, right? It happened anyways. So the reason why I think that 2026 is more likely to be a bear market than not is because I'm a product of my own experiences. And every single midterm year has been down. 2014, 2018, and 2022. And the top always formed in the fourth quarter of the year before the midterm year. That's why. So how do we compromise? How do we reconcile the difference between the 4-year cycle tops that we've seen that have happened under euphoria and then potentially this top? And even if you get a higher high in December, which I don't know. I mean, I don't know if that's the most likely outcome, but anything's possible. How do you reconcile it? Well, first you say, what if this top in 2025, either October or December, but not looking great at the moment. If we can get back above the 50-week moving average within the next week or so, then we'll see, okay? How do you reconcile it? Well, what if this down period in the market by Bitcoin in 2019, what if that ends up being the 2026 bear market, right? Where you get a downturn in the market, right? Like you get a downturn in the market, and the 4-year cycle ends up being right again, but for just a different reason. Because a lot of people are looking at this and saying, well, hold on a second, Ben, you're forgetting one thing.
Hackers and scammers aren't just a threat anymore. Chances are you're already being targeted.
QE is coming, right? Jerome Powell said they're going to stop quantitative tightening in December, and that's only a couple of weeks away. So who are you to sit here and say that it has to go down for the next 2 months? Like, who are you to say that? Well, if you actually look at what happened last time the Fed ended quantitative tightening, what you'll notice is that QT came to an end in August, and then you can see that it bottomed here in September. And when that happened last cycle, Bitcoin actually topped a few months before QT ended, a few months before. And then after QE began, Bitcoin continued to go down for a little while. So what I'm suggesting as a possibility is, in the same way that QT is going to end in December, is it possible that Bitcoin has a top a couple of months before QT ends, just like it did in 2019? It then bleeds into it. After QT ends, it drops even further, and then that drop just ends up being the 2026 bear market. One way that it could work is you could say, well, hold on a second, Ben. If you exclude the pandemic, which is exactly what we're going to do, I don't need, you know, I don't need to see in the comments about, well, you're talking about the pandemic. No, I'm not talking about the pandemic. Well, if you want to comment on it, you can. It'll help the video. But I'm not talking about that, right? I am simply talking about the 50% drop that Bitcoin had before we went into the whole pandemic stuff. That's all I'm talking about. I'm talking about a clean 50% drop from the high. And when you see that 50% drop from the high, you'll notice that it took place from June until December. So about 6 months, about a 6-month drop. Now, in this case, you have a 6-month drop, and it might make you think, well, what if this one ends up being 6 months? You know, is it possible that if the top is October, then you go November, December, January, February, March, April, is it possible that this one only ends up being 6 months? And if it is, could you have a low around May? Yeah, it's possible. It absolutely is possible. In fact, I would still lean towards, if the top is October, I would probably lean more towards a low next October. But if we are setting up for a bear market in 2026, I will start to look for signs of a low as early as May, even though that doesn't really seem like the most likely outcome.
I don't know. I kind of disagree a little bit. I think this is assuming that institutional ownership, institutional interest is consistent throughout these time periods. That's where I kind of disagree. I think it's a little bit different that we are seeing a significant amount of institutional interest in a lot of these ETFs that are piling up to this kind of into cryptos. That I don't think I don't know if the cycle is going to continue repeating the way that these kind of saying it would.
The high. Now, a 70% drawdown from the high would put Bitcoin basically right around 40K, around 40K. And honestly, I mean, maybe that should be my base case, but the reason why I'm not so sure about that is because these prior bear markets occurred on euphoria. And when they started from low Bitcoin dominance levels, right? I mean, you guys knew I was going to work it in. Low Bitcoin dominance levels. So look at the 2018 bear market. When did it start? It started from a low Bitcoin dominance level, right? Dominance was at 35%. In 2021, January 2022, dominance was at 39%. Now, it could be that by January, maybe dominance will be all the way back down to 40% or something. Maybe. But what if it's not, right? Like, what if it's not? What if it's still hanging out up here? Because one of the ways that you get dominance to drop is by witnessing higher highs in the social interest, right? In social risk. But if you go look at the social risk, no one's here. I mean, yeah, so there's dozens of us, but no one's really here. If the orange line, the social interest, like look at where we are now compared to 2021 and 2017. One of the reasons why bear markets are so brutal is because all the retail investors that flock into the space at the top, they end up providing the sell pressure for the next year. So for a lot of long-term holders that maybe never sell the Bitcoin, it doesn't make sense to them like why the price would go down 80%. But the price is not going down 80% because the long-term investors are selling. They might sell at the peak, but they're not usually the ones selling throughout the whole bear market. The people that sell through the whole bear market are the short-term investors, the tourists that come in and buy the rallies at parabolic tops. That is who is typically responsible for how brutal the bear markets are. That's why it drops 80%. It's because of the tourists that come in. They buy the top, they sell the bottom, and they don't learn their lesson. A few people stick around, they learn the lesson. So, can you have an 80% drop? Is it possible? I mean, anything's possible, right? Like, obviously, there's all sorts of events that you cannot predict. Anything is possible. But the main reason in the past for 80% drops is when retail is flocking in at parabolic tops and they provide selling pressure for the next year. What you'll notice about the 2019 drop is that it was really slow. And it was because we topped on apathy rather than topping on euphoria, right? So instead of topping on euphoria, we topped on apathy instead, and therefore it left people wondering like, well, can there be something else, right? Like, is that truly it? Or is it possible for there to be something else? And so what ended up happening back then is QT ended, the Fed, they were cutting interest rates, but you could argue that even though they were cutting, rates still were not anywhere close to maybe what they needed to be to really get Bitcoin back in business. And you could argue the same thing is going on right now. Like, yes, rates are dropping, but right now, we don't even know if the Fed's going to cut in December. In fact, right now, it's more or less a coin flip as to whether they cut in December or not. Guess what? In 2019, they did cut in December. And when they cut, it ended up marking a low, right? Ended up marking a low. And back then, you can see Bitcoin also sort of sold off into mid-November. And then it basically stayed flat for the rest of the year. And then we had a rally. And then ultimately we had the pandemic drop, right? We had the pandemic drop. What I'm thinking about right now, though, is the fact that the Fed funds rate is still above the 2-year yield. And one of the interesting things about that, so if you look at the Fed funds rate, it's currently at 4%, but the 2-year yield is at, I believe, It's at 3.6%, right? So it's about 40 basis points below the 2-year yield. You could argue that if you want to treat the 2-year yield as sort of as a theoretical neutral rate, which is this abstract idea, where if the Fed funds rate is above the neutral rate, the economy slows down. If the Fed funds rate is below the neutral rate, the economy speeds up. You could argue that if the Fed were to cut aggressively, it would reignite the animal spirits.
Hey traders, in this video, we're going to introduce the Smart AI Indicator, which we developed in partnership with OpenAI. This is the first crypto.
So how do we reconcile all this stuff, right? Because we've gone through the 4-year cycle stuff. And really, if you look at the ROI from the low for the last 2 cycles, and you can see where Bitcoin has so far topped this cycle, it basically topped when it always does, when you measure the ROI from the bottom. If you measure the ROI from the halving, you can also see that when Bitcoin found this high in October is around when it normally does. Like, it wouldn't be that surprising if we look back on this and we're like, okay, yeah, that was the top. That's normally when the top is. The only thing that would have provided some hope is if you measure it peak to peak, and then you look at this cycle compared to 2017. But the problem is back then, Bitcoin was also topping within about 3 days when measuring it peak to peak, okay? So a lot of ways you measure it from a time-based perspective is what makes people bearish. They live through the 2022 bear market. They live through the 2018 bear market, and some even live through the 2014 bear market. And they don't want to go into 2026 saying that this time is different, even though there's not euphoria. They don't want to fall into the trap of, oh, it's different because there's not euphoria. Because last cycle, it's different because we have institutions coming in. Now, obviously, this cycle, we had way more institutions than we probably could have ever imagined, and we had ETFs. But last cycle, it was all about, oh, what company is going to be buying Bitcoin next? And that's what kept people hoping. This cycle is something different. Every cycle, we are thrown a curveball. Every cycle, we're thrown a curveball. So that's the time-based stuff. And if you look at Bitcoin, and you just look at the 50-week moving average, this is one of those things where when you look at it, what you'll notice is that every single time it's gone below the 50-week, every single time the price has gone below the 50-week moving average, this late into a cycle, it is historically meant it was over, right? You can see those examples right there. And so it's hard to look at that chart and immediately say that, oh, this time has to be different. Normally what happens after we drop below the 50-week moving average is we have our date with Destiny and Bitcoin goes to the 200-week moving average in the midterm year. You can see after it drops below the 50-week, we then go to the 200-week after 2014, same thing in 2018, same thing in 2022. We actually went below the 200-week estimate back then. Why can't it happen in 2026? Is it just because we topped on apathy? In 2020, in 2019, we topped on apathy and we still went to the 200-week moving average. So from the time-based perspective, it's not hard to understand like why people are starting to flip bearish, because we've seen this before. Now, the reason why it's hard, in 2019, we also got a weekly close right here below the 50-week, and then it just kept holding. Like it would drop below it, and then it would rally back above it the next week, and then it would drop below it, and then it would rally back above the next week. And then it kept holding at the 50-week, and then we ended up getting one more rally. Who knows what that rally would have turned into if the pandemic didn't happen. So that's why I'm trying to be somewhat flexible on this. Like I think there's probably a 60% chance the top was in October. There's still a chance, you know, who knows what could happen. There's still a chance you could have one in December, but it's starting to look a little bit less likely, even though it could still happen. We need to see Bitcoin back above the 50-week moving average. And if you get that, then who knows, right? I mean, yeah, maybe. The other thing is that near the end of cycles, when you have a death cross, when the 50-day SMA crosses below the 200-day moving average, you can see that every single time that has happened this cycle, it's formed a low within a couple of days. A low within a couple of days, every single time. And so we just had a death cross, but we haven't yet formed a low yet, potentially. I mean, maybe we have, we just don't know it yet. But if the cycle is not over, Bitcoin needs to rally like yesterday. Because what happens when you get a death cross and you don't get a rally is exactly what happened in 2022 when you had a death cross. Because back then we had a death cross, we had a small rally, but if we don't go anywhere, people give up and they sell. And then what happens is you get a drop and then you get a bigger rally to the 200-day moving average. That's what also happens at the end of every cycle. You can see you get that rally to the 200-day moving average. It ends up being a macro lower high. It even happened in 2019, right? It happened in 2022 as well. It also happened way back over here in 2014. So that 200-day moving average, if the top is in, is likely going to come into play within the next few months, where it will likely form a macro lower high if the top is in. Now, if Bitcoin can rally this week back above 100K or 103K, it leaves a little bit of flexibility. But if we get another weekly close below the 50-week moving average, the odds start to mount that the top is in, and whether the top indicators went off or not, it's irrelevant. There's going to be too many people that are going to think that 2026 is not going to be a good year, and they're going to start to fade. And then maybe once we get much looser monetary policy, people will come back to the table, just like they did after the 2019 downturn. So from a time-based perspective, it's very clear. The other thing I wanted to bring up is, very briefly, MicroStrategy. All right, I want to talk briefly about MicroStrategy, because MicroStrategy arguably is, it's doing the same thing they did last cycle, basically. but Bitcoin is behaving in a slightly different way. So look at what happened with MicroStrategy last cycle. It found a top in February and then a lower high in November. And then after that, it went below the support level. Is that not exactly what just happened, right? Basically, you have a top here in November and then a lower high, and then now it's gone below. So if this were to play out the same way, there's going to likely be, at the very least, a bear market rally for MicroStrategy at some point. Would be my guess, right? Because a lot of times when you get these breakdowns, everyone then panic sells, and then you get this potential bear market rally back up. Okay? Now, my guess is that rally by MicroStrategy, if the top is in for Bitcoin, would correspond to Bitcoin rallying back to the 200-day moving average. Notice in 2022, Bitcoin rallied to the 200-day moving average in April, and MicroStrategy had this bear market rally top in April. But that is where Bitcoin rallied to its 200-day moving average in April. So it would form a macro lower high. And notice that Bitcoin did not go below this intermediate low before the bear market rally to the 200-day moving average, right? So MicroStrategy did, but Bitcoin did not. Bitcoin did eventually go below it, but it was much further on into the bear market. Now, one of the reasons why being open-minded to a low as early as May, if the top is in, or even if there is a higher high in December, is because in 2022, MicroStrategy actually found a low in May. It then swept the low about half a year later in December. But if you bought MicroStrategy back then in May, you essentially bought the bottom. And then it rallied from 13 all the way up to $500 a share, over $500 a share. So I want you to look, though, at one slight difference, which is why I'm not being as deterministic as I maybe otherwise would be. If you look at this, it would be pretty clear in a lot of different ways from a time-based perspective that we are due for a downturn going into 2026. We're due for that. And then it's just a normal part of the cycle. Bear markets should not be scary. Trade the market that you have, not the market that you want. Bear markets allow you to get in positions that then you can ride for several years. Okay, they're not a bad thing. Again, what I've said before, right? The money is really made in the bear market, right? If you have the courage to buy in the bear market. But in this case with MicroStrategy, back then in 2022, it formed a lower high for Bitcoin USD. But what's interesting is that if you look at the lower high by MicroStrategy in 2021, it was in November. When did Bitcoin top? November. But then if you look at this cycle, the lower high was in July. But Bitcoin didn't top in July, right? It had a top in July, but then it went higher in August and October as well. So
I studied the 10 most powerful empires over the last 500 years and the last 3 reserve currencies.
Is it possible that if you have a rally by MicroStrategy back up, is it possible that Bitcoin could exceed the 200-day moving average? Yeah, it's possible. In fact, in 2019, Bitcoin did exceed the 200-day moving average. It did. So it's not impossible for something like that to occur. So I still think, as I've said for a while, the top is either, from a time-based perspective, October, because that's when the ROI from the low would suggest it would be. Is there still time for euphoria? I don't want to say it can't happen, but we're running out of time, right? We're running out of time. Doesn't mean it can't happen. It's just, who knows? There's only theoretically about 6 weeks left. Now, I do look at this and I wonder, is it possible that we just kind of go down into December, we get an into QT, then Bitcoin maybe gets a little bit of a bounce into early 2026, and then we still have a bear market? Absolutely. That's how it could play out. But I do wonder about these divergences, because when you look at when Bitcoin got a higher high on the USD valuation, it was on this little rally by MicroStrategy right here. So if MicroStrategy were to get a bigger rally, then maybe there would be another nice knee-jerk bounce by Bitcoin back up to the upside. Hopefully before it would go below, these lows over here, which that would be kind of repeating what it did in the last cycle, right? Getting a nice multi-month bounce back up to at least the 200-day moving average within the next 2 to 3 months would be kind of probably the baseline expectation. Because a lot of people are asking me, well, MicroStrategy just dropped straight down and took out this low. Could Bitcoin do the same? Well, last cycle, MicroStrategy did the same thing, right? It just dropped, took out the low, and Bitcoin dropped, but it didn't take out that low. It still had a rally back up, and then eventually it took out the low. The peak indicators that a lot of people are curious about include things like the pi cycle top. But I don't think the pi cycle top's would have ever signaled, because if you take the moving averages and you divide them and you extrapolate this trend line, it's not going to go above 1 this cycle regardless. And so you could argue that if it was not going to go above 1, there was never going to trigger anyways. But it would have suggested it would have gone higher than where it is right now. So what if where this pi cycle top is more similar to, again, the 2019 top, where they came close but not really that close, and then there was a downturn, but not as deep as the other bear markets. There was a downturn, but then the money printers came back on, and then we had euphoria. It's possible. So again, there's a chance here that the 2019 downturn that started before QT ended could just be the 2026 bear market that started in Q4 of 2025. And what if you get maybe a 50% drop instead of 70. Because a 50% drop from the high would actually put you between 60 and 70K. And the reason why that's interesting is because that's exactly where the 200-week moving average is going to be in 2026. And you can see that in the midterm years, Bitcoin tends to return to the 200-week moving average, sometimes even in other non-midterm years. It tends to at least go to the 200-week moving average. So perhaps we have our date with destiny after all, but maybe the bear market is more tame. And you know what's interesting is if it plays out like that, if it plays out like this, where you have your bull market, and then you have sort of like a smaller bear market, and then another bull market, I feel like both sides could kind of claim they're right? Like, you know, the bears could be like, well, yeah, like we said there was going to be a bear market in 2026. Like, why didn't you listen? Like, we always have a bear market. But the bulls could say, well, I mean, a 50% correction, is that really a Bitcoin bear market? I mean, obviously a 50% drop in stocks would be horrible, but in Bitcoin, I mean, a 50% drop is a Tuesday afternoon. So, you know, maybe there's a way. I don't know if we can do this on TradingView. ISM, can we look at the ISM on here? Maybe we can't. I can't remember. I feel like it is possible. But I can't fully remember. Let's see. Okay. I think I got it here. So we're going to go with this. Here we go. Okay, so here's the ISM. If I can. Okay. This is a really interesting chart because the ISM, the Purchasing Managers Index, shows you that these prior peaks by Bitcoin correspond to peaks in the ISM. You see that? Now you know why retail's not here, guys. Look at the ISM. The ISM looks more like the bear markets than it does the bull market. No wonder retail's not here. It's because Main Street is struggling. Wall Street has been doing fine. The S&P is doing fine. Main Street, they're the ones stuck in traffic on Struggle Street right now. So it has been trending up. And so some people are saying, well, you know, maybe if it goes up in 2026, Bitcoin could go up. Well, what if it's down here and maybe the next time it goes up isn't until say like 2027 or 2028? So again, you could have I'm not like, I don't look at this chart and it's not like I don't sympathize with the people that have these views. Like, yeah, like the reason why retail's here is because this looks more like a bear market than a bull market in terms of the ISM. That's why retail never came back. That's one reason. But that doesn't mean they're going to come back in the first half of 2026 either. And you know one of the reasons is because Jerome Powell is going to likely be replaced as the chair of the Federal Reserve in May of 2026. And I don't think he wants to leave his post aggressively cutting interest rates and being blamed for inflation coming back. I think he's going to be very difficult to convince to bring rates down a lot. I do. I really do. Let me see if I can get this to load here so we can look at it. The markets are currently saying that Powell will cut one more time before he leaves. Because again, he would be replaced in May. I don't think, he'll still be there. He just want to be the chair. They're saying he'll cut one more time. Powell will likely be replaced by someone a lot more dovish. And when rates come down a lot more, and when the money printers likely come back on, because that's the only way they know how to fix our problems, unfortunately, then things could change. You know, maybe things would change at that point. But the problem is that in the first 5 months of 2026, there's going to be those macro headwinds, right? There's going to be those macro headwinds. I'm not saying the ISM can't go up. I'm just saying that by the time it goes up, like, do we really think it's going to go from, 48 back up to the 60s or the 70s within the next, 6 months? A lot of times it takes a long time. I mean, back over here, it found a low in 2012, and the high for Bitcoin wasn't until a year later. In the next cycle, the low was in January 2016, but the high for Bitcoin wasn't until almost 2 years later. In 2020, you had a low in May, and then Bitcoin topped about a year and a half later. So even if the ISM were to start aggressively going up, it doesn't mean that then Bitcoin has to immediately go up in early 2026. It could be you get that sort of shorter term drop just to allow the market to reset, and then we continue higher, maybe before a 70, 80% drawdown. So the argument is, if you don't top on euphoria, do you have to have an 80% drop in the bear market? Maybe not. Maybe you get more of like a 2019 style 50% drop, which would still be in line with everything, right? It would still be in line because that would also put you between the two, at those prior all-time highs. That's where it would put you.
Hey traders, in this video, we're going to introduce the Smart AI Indicator, which we developed in partnership with OpenAI. This is the first crypto.
It's got to be a possibility, right? So I can look at something like the price cycle top and be like, yeah, like what if we just get that brief downturn in the first part of 2026 and then things start to pick up after that? You could also go look at something called the terminal price, another indicator. Now, what's interesting about this indicator is that it also hasn't gone up to the red line. But guess what? It didn't in 2019 either. It kind of stalled out. It went down, and then it barely got below the green line during the pandemic. And that was, imagine that was a crazy drop. It did go lower if you look at Wix, but where is the green line today? Where is it? It's currently at 56K. It's probably going to be above 60K by mid-2026. So you can kind of see the same thing playing out, just on a grander scale. but the 4-year cycle could still remain intact, right? Like you could have a scenario where you have a drawdown, but it's not as bad as the bears think, and it's worse than the bulls think. So then everyone ends up claiming they're right. Either everyone's right or everyone's wrong. I don't know how you look at it, but that's what makes it a market. The bulls have a point, right? There's no euphoria. How do you have an 80% bear market when Bitcoin dominance is sitting at 60%? Normally the bear markets, the aggressive bear markets, start at low Bitcoin dominance levels. But we did have a bear market, the 2019 bear market, that started in June of 2019, and Bitcoin dominance was at the same level that it's at right now. So it's not impossible to have a bear market from higher Bitcoin dominance levels. It just means it might not be as bad because you don't have euphoria. You don't have retail coming in and panic selling every low. The people that are here today have been here for probably years. So that's where I am on this stuff right now. The bulls have a case. The bears have a case. Over a long period of time, the bears sound smart, but the bulls make money. That's the reality. I mean, right, it is. And I'm not saying it won't ever change. I mean, at some point, we probably will have a more prolonged downturn because all markets eventually do. But there's been 1,000 times through Bitcoin's history where you could argue that the bears had a good point, but the price still kept going up. And even though the price went down for periods of time, you know, think about all the crazy Bitcoin skeptics that said they were right every single time we had a bear market. Do you think any of them ended up buying in at the lows, or did they just become skeptics again and claim they were right at the next peak? You have to think about it, right? Like, think about it from that perspective. It's easy to just constantly say that, you know, to make all these accusations about what Bitcoin is because it starts to drop. But if they did it after every prior top, what credibility does that argument have? Because they'll just do it again in 4 years and claim they're right again. So just be careful. Try not to fall into those traps because I mean, it's easy to, right? It absolutely is easy to fall into those traps. But that's generally my view. In the short term, I know a lot of people are like, well, you know, what about this cycle? Like, you know, is it possible that Bitcoin could go back up? It's tough. Like, we're running out of time. The time-based aspect of it is a major headwind right now, right? It's a major headwind. The lack of euphoria could be a potential reason for a tailwind if there's any type of, any type of catalyst that could start things moving and get people to at least believe, oh, we're going to head into a euphoria phase. But it could just be another divergence. The other thing that we talked about is the relative strength index, because the relative strength index, you know, is something that you would really want to see hold at these prior lows, but you can see it's broken through. And in 2017, when it broke through in January, you know, the cycle ended up being over, right? When it breaks through, it's usually not a good thing. I'm not saying you can't have fake outs, but generally speaking, you have to at least be open-minded to, you know, to getting a rally back up at some point, but it just being a lower high. So the RSI doesn't really look that great. The monthly RSI obviously left something to be desired this cycle because you can see that there's no euphoria, right? This monthly RSI just looks kind of like what happened right there in 2019, where it went up, but it didn't really go up as much as you would think. It came back down, it reset, but not at the lows. It reset at a higher low, maybe like right here, and then it went into euphoria. So there's certainly a chance that all that could happen. One way this could play out on a more grander scale is the Powell cuts rates again. We end up getting a 2026 sort of bear market that maybe lasts for at least 6 months. The new chair comes in, they cut rates, they turn the printers on, you then get the next cycle, and things start to rally again. But then they realize they're starting to reignite the animal spirits, inflation starts to come back, and they have to raise rates. That might sound crazy. That's exactly what happened in 2000 in the dot-com era. That's exactly what happened in the dot-com era, right? So if you look at the S&P 500 and you look at interest rates, you can see that they were lowering rates some through here, but then eventually they had to raise rates again. And that's what ultimately killed off the animal spirits, and then we had the dot-com crash. If you look at that whole move through the lens of M2, the money supply, I would argue that to some degree, it's still playing out almost perfectly. If you take I think it will diverge, to be clear, but if you take a bar pattern from 1996 until the actual top, even that 20% drawdown we got back in April, March lines up. So you could argue that we're kind of getting close to this drawdown right here into early 2026. But it still doesn't mean it's over necessarily, right? It doesn't. And the other thing too is you could argue that it could very well diverge, right? It could very well diverge. There's obviously a lot more companies now that are actually using AI, and it's improving efficiency, and it's actually allowing them to generate a profit, whereas back in the dot-com era in the early days, a lot of the companies weren't really generating a whole lot of profit, and things were more crazy back then than they are today, right? They were. But it is something to at least keep in mind, keep in the back of your mind. So those are my views. I hope it's useful to you. I think both sides have a case to be made. I think one way you can reconcile it is to say, like, what if we're like kind of in this phase where the market is just kind of begrudgingly dropping a little, but it's not exactly like what you've seen in the prior bear markets after major euphoria phases. So I want you guys to keep that in mind. We'll keep talking about the markets and trying to figure out what's actually going on. But those are my views. Those are the case for the bulls and the bears. That's at least one way we could potentially reconcile it. In the short term, if Bitcoin can get back above the 50-week moving average, then we'll look at the potential upside. But until that happens, I think we at least have to sort of be aware that normally when you get these closes below the 50-week, it's at least worthwhile to start thinking about like what could that look like going into the midterm year. And my guess is this, in a very unambiguous, like I'm not trying to say what I mean. Regardless of what happens for the rest of this year, I do think that Bitcoin will have its date with destiny at the 200-week moving average in 2026. And my guess is that date with destiny will be somewhere between 60 and 70K. And it should happen. It'll probably happen sometime in 2026. If you guys like the content, make sure you subscribe to the channel. Give the video.
So essentially, short the market. Short the market. Short crypto. So if that does happen, I mean, it is really scary to be in a lot of these leveraged crypto plays, or even like in companies like BMNR. BMNR is kind of interesting because their crypto they can stake because they have Ethereum. So I don't know how well the others are gonna do. So it's a little scary, like how Stride, Strive, Star, all those ETFs by Michael Saylor are gonna do. Q3 earnings coming up on Nvidia. I think this is gonna really change the market. We have to reflect. This earning report is gonna be so important for the industry because it's gonna move the market, and it's really scary. This is the other video I said we're gonna watch, so let's go ahead and check it out.
It's Crossroads here. Today I want to talk to you about BMNR, that's Bitmain Immersion, and also Ethereum. The stories are linked. Both are crashing. Are we doomed? To save you some time, the answer is no. Have a great day. If you want to know why, I want to show you why. And so let's take a look here. And by the way, this is mostly centered around Ethereum specifically. There will be some BMNR references, but it's the reason why BMNR is decreasing in value and is crashing is because it's being pulled down at the same time as there's weakness in the market. Ethereum price is being cut as well. Ethereum is a little bit over 3,000. BMNR is a little bit over 30, and both can break below support. So are we doomed? Absolutely not. So let's take a look here. The first one of these I want to show is this right here. This is Ethereum Exchange Reserve on all exchanges. And you can see a very clear trend. Let me see if I can blow this up a bit. This goes all the way back. I mean, it doesn't go super far back. We're going back to 2023. Let's see if we can go out a little bit further. I believe we can. There we go. Yeah, that's as far back as they go. So we can see right here, this purple line is the Ethereum, the exchange reserve. And so this is looking at all exchanges. You can see there's a whole host of them. You can see all the big ones here, all the small ones, and everything in between. There's a ton on here that I know and a ton I've never heard of before. So if you look at the actual reserve amount on the exchanges, so this is what they have available if somebody wanted to snatch them up, the supply has decreased immensely. Now, if you go back, it was around 25 million. So a lot of the supply was available. If we were looking at it best back in 2024, we'd see that it's been cut pretty tremendously. And you can see this ridiculous fall really since here in the beginning of summer. So looking around June 30th, July 1st, what event happened to decrease the available supply from 20 million to about 15.5 million? The simple answer is BMNR happened. Now, it wasn't just BMNR, it was other Ethereum treasury companies as well. Let's zoom out a little bit here. Maybe we'll look at this on a weekly basis. And yeah, right here at June, there was a small amount, not enough to really make it appear on this graph. But in July, of course, a lot of treasuries really took off as far as their buying. And we're looking at quite a few of these if we look at the supply and everything. Of course, BMNR owns and holds and buys the most. That's why I continue to hold it, one of many reasons. But we can see that there's a lot of other players here. Now, some of them are accumulating a lot faster than others. BMNR again. But others are accumulating, even if it is a bit slow at times. And I think that if things switch to bullish, that accumulation will certainly at least continue, but probably accelerate. We did see BM&R buy, and they reported their buy, by the way, today, a little bit less crypto than usual. They're trading perhaps under MNAV, but nevertheless, this trend is very clear. And again, when we look at supply, let me show you this one more time. We're looking at just over 5 million Ethereum, 5.2 million. That accounts for this. Now, I know that there's other factors as well, but that's the biggest factor right here. Now, do you think for a minute that Tom Lee and BM&R are going to say, you know what? Ethereum is terrible. Let's go full port orbs. They will not. That is not how Tom Lee thinks. That is not how BM&R operates. That's not going to happen. Now, what can happen with some of these digital asset treasuries over the short term, well, like we saw with Exilla, is when they were trading massively under their MNAV, and so what they were holding in terms of Ethereum was a lot more valuable than the sum of their entire company, that they sold some, raised some cash, bought back some stock. You may see some more of that, especially if the MNAV really dumps far under. I would be a little bit surprised if BM&R did it unless something absolutely ridiculous as far as the disparity of price happened. But again, these treasuries are not just saying, you know what, the treasury doesn't work, Ethereum doesn't work, we're done with this. Instead, they will continue to accumulate over time, even if we do see short-term bumps like this little bit here. The trend is your friend. So what happens when we get below, like to zero on the supply? Now, first, for that to happen, it's going to take 15, maybe 16 more months if everything stayed exactly the same as it did from the beginning of that inflection point with the digital asset treasuries. I actually think, things don't move down in a straight line, even things like this. And so there will be some rebound, it'll be some consolidation and so forth. Treasuries, like I mentioned, might slow down their purchasing, and so might individual holders as well, although we're a lot less significant than the institutions and the digital asset treasuries. Nevertheless, if these assumptions hold true, 15 months from now, we're suddenly at a place where there is very little to no Ethereum left on the exchange. Now, again, more likely, it's going to be slower. And then towards the end, when we get down to 5 million or so, that's just a guess, paper math, napkin math rather, then you're going to see an acceleration in terms of purchases because people know what's about to happen. This is a simple supply and demand equation. Right now, there's still plenty of supply, even though there's less and less. But at some point in the future, Ethereum will be much harder to acquire. And as a result, the price is going to accumulate. That's the biggest argument for the price right there, since there's no such thing as earnings per share. Now, the second reason why I think that things are fine is not just for that, but also because the stablecoin thesis. Now, stablecoins are a huge part of the Ethereum thesis, just because most of the stablecoins are actually built around and on Ethereum. They do launch on many other cryptos, but you can see right here, this is on Artemis, by the way. DeFi Llama is also very good, though I'm just going to use Artemis this time. But you can see stablecoin supply by chain, and we can look here over time. Stablecoin tokens have continued to go up, although there was a slight decline so far in the month of November. We'll have to see how that actually looks. It's actually the first decline since, I believe, September 2023. So that is interesting, and it is something to keep an eye on. But what's really interesting, if we go over here to the individual chains, okay, first, look at Ethereum. 303 billion in stablecoins. 170 billion of those are on the Ethereum network. Ethereum is the stablecoin network, though there certainly will be other players. But let's look and see what happens if we just put Ethereum here alone. We can see, remember, November decreased slightly.
Hello, traders. In this video, we're
decrease for Ethereum. It just keeps going up anyway because, again, Ethereum is stablecoin. So the stablecoin thesis, which is very important and very relevant to this centralized thesis on BM&R and other digital asset treasuries, and Ethereum really taking off as this chain. It's what institutions believe. It's why institutions are adopting it, driving volume as well. That is very much intact. Now, if you look at the actual usage and everything, that's gone down a little bit as well. If we look right here on the right-hand side, overall, not just on stablecoins, but Ethereum, you can see that this is lumpy and bumpy. Of course, weekends tend to be a low point. There's a lot less activity typically there. But yeah, it has descended somewhat. And you can look at this, as far as volume elsewhere as well. Now, the last little bit of this is not just is it that the stablecoin thesis is attacked and the exchange volumes continue to decline, but we also see that staking is extremely stable. Now, if you're not familiar with staking, I'm not going to explain it too much in this video, go look it up. But as a reminder, it takes a while to unstake your Ethereum and actually exit, just the way that the validator network operates. There is a bit of a queue, and we can actually see this here, validatorqueue.com. We can see that there's a lot of people on the exits. Now, you might say, Roy, this is terrible. It's really showing that people are heading, oops, let's cross that one out instead, that people are running to the hills and trying to get out. Well, look at when this started. This was in September, and it had a sudden spike. Basically, what happened is one of the validators ended up no longer being eligible, that they hadn't gone through their necessary upgrades. And as a result, they were going to be forcibly removed from the validator network. As a result, the validator queue absolutely spiked. Now, you're not seeing, despite the drawdowns in November, because we were okay in October, boy, it's really fallen in November at the same time as the Ethereum price has as well. Now we can look at entry and we can see, entry actually started spiking in October, and it is descending there. That's not overly concerning though, because this whole time right here where you see the entry is fairly clear, the price can accumulate anyway, and the queue wait time is measured in days there. If somebody wanted to actually exit their position and it's currently staked, you're looking at maybe 30 plus days to actually exit. To onboard, you are looking at some time as well, about 20 days too. Just that's the nature. By the way, here is the active validators decreasing, one of those things that we mentioned here. So in other words, as Ethereum really started collapsing in terms of price, you're not seeing a massive run to the hills. Otherwise, this blue line here would be spiking up rapidly, or rather, it would be the other way. The red line, which is the exit, would actually be spiking up rapidly. Instead, as this is digested by the network, and that will take time, we're actually seeing that decline over time. And I think that that will continue to play out as well. So,
all right, that was November 5th, right? So how does that make sense? So he's saying November, so we're looking at what? November 15th. All right, maybe that number is okay. November 15th. Okay, so we're sitting about here. But we did see this September 4th exit. Huge exit. What happened in September? Well, November 2025, September. Here's September, and I guess there was a massive number of investors, as you can see, around that September 4th, where they just exited the market. And that's about a couple months, maybe 1-2 months before it took off and dumped significantly. All right, it is a strong case that investors are not just running away. Because if they just ran away and stayed consistent, maybe it's a problem, but they're starting to come back in. Entries are also going down, so you're not getting any new entries, but you're having less people leaving, which is a good sign.
Instead, as this is digested by the network, and that will take time, we're actually seeing that decline over time. And I think that that will continue to play out as well. So you might also be concerned and say, well, what about ETFs? So Ethereum ETFs, this is a weekly digest. Let's see if I can zoom in a little more here. There we go. So you can see, yes, it's negative. It's negative this week. It's negative the previous week in November. October was more of a mixed bag. September was surprisingly strong. I mean, that's usually a crypto week month. I don't know. But regardless, yeah, there is an exit, and you can see the exit is increasing, that there is some consolidation or move away from some risk on type of positions, both in the equities market, but also in crypto. So it's not too surprising, but this is a lot. 728 million, almost $1 billion of as far as exiting. It's something to keep an eye on. But we also have to keep in mind others are also buying. So they did not buy nearly as much as what exited, but they own a massive amount. They continue to buy each and every week. So do many other players, not just digital asset treasuries like Bitmine. And so, yeah, there's going to be weeks where there's outflows, especially when there's things a little bit less certain as far as a macroeconomic environment. But staking is relatively stable. We're not seeing any massive drawdowns. It's just kind of the way it is. And this, by the way, is before. Let me show you one more chart here that I forgot to show at the very beginning. Supply staked. You can see it hovers, it's about 28.5% right now. It has been up just a little bit under 30%. BitMine owns 3.6 million, not Bitcoin, Ethereum, 192 Bitcoin, so much smaller there. When they stake it, it's not an if, but it's a when, and they may not stake all of it, we're going to see an all-time high in terms of staking. So this is not people fleeing for the hills. This instead is a short-term downtrend going back to beginning in that capitulation or liquidity event in mid-October. Now that's continued. It's not going to continue forever. The thesis, for me anyway, is still very much intact. Let me know what you think in the comments. Are there other indicators that you're seeing that are important to you that are telling you that the thesis is very much intact? Or are you saying, you know what, it's over, or I took on too much risk?
Well, we just saw that technical analysis. And that technical analysis is saying, things might not be as they seem. And crypto might end up just dumping. NYPD instructs Americans on Shura. Wow. AI bubble, what's going on? Let's watch this video by Graham Stephan. We'll watch it at 2x and then we'll go from there.
If you don't believe creating SOPs can take seconds instead of hours, you haven't tried Scribe. Check out the...
What's up, guys? It's Graham here, and this is getting out of control. Overall, it seems like more and more people are worried about investing into an AI bubble. Job losses are accelerating at the fastest pace since 2003, and the situation has gotten so bad that even Michael Burry has just quit the market. Meanwhile, the top 10 companies now make up a record 42% of the entire S&P 500. The bottom 50% are completely negative for the year, and the best stock trader in the world, Nancy Pelosi, has announced her retirement for 2027. That's why we gotta talk about what's actually going on, how some investors are about to make a ton of money, and how 2026 could be one of the biggest opportunities we have ever seen. Because believe it or not, there are proven strategies to be able to make money in any market that most investors are completely unaware of. And this is so important that these next 10 minutes could be the complete difference between missing out and getting rich. Although before we start, if you find these videos helpful, please hit the like button and subscribe if you haven't done that already. I hate asking for it, but my analytics show that just mentioning it makes a huge difference for the entire channel. And as a thank you for doing that, here's a picture of a baby goldfish. So thanks so much, and also big thank you to Moomoo for sponsoring this video, but more on that later. Alright, so to start, when it comes to investing, even though you might see screenshots on Twitter where people have magically turned $10,000 into $10 million, I hate to say it, but it's probably a good idea to realize early on that you're most likely not going to be the next Warren Buffett who will see these crazy returns indefinitely. I mean, sure, I know it sounds easy to sell when Trump talks about tariffs and buy back in when he announces a resolution, but when it really comes down to it, your odds of getting any higher than the market average is so small that 90% of actively managed funds failed to outperform the S&P 500 over a 15-year period. Now, sure, in the short term, you will naturally see outliers, some of which are either incredibly talented, at the right place, at the right time, or Nancy Pelosi. But what I found most surprising is that even the funds that do beat the market still have investors that wind up losing money. And a perfect example of this is what's called the Magellan Fund. This was the world's best-known mutual fund, which had record-setting growth under the management of Peter Lynch from 1977 to 1990. But despite their incredible success, having outperformed the market by a long shot for more than 15 years, it was reported that the average investor lost money during a time when the fund returned around 29% annually. How? Well, during those years, there were both good times and bad times. And unfortunately, instead of holding through it, the average investor would buy in at the peak after it's already gone up in price, and then sell as soon as it fell, thereby locking in their losses and missing out on all the subsequent growth. Now, even though this sounds like a perfect case of don't time the market, it's a good reminder that you shouldn't be buying stocks because you're chasing returns and expecting higher than the market average. I mean, this is exactly what's happened throughout most of Cathie Wood's funds once she outperformed Warren Buffett. But that didn't last, and long-term Warren Buffett once again came out the clear winner. The same applies to Michael Burry, who recently shorted the market and then subsequently shut down his entire fund, allegedly saying, "My estimation of value in securities is not now, and has not been for some time, in sync with the markets." Although speaking of market returns, there is another problem I would like to discuss, and that has to do with stock prices. Look, every time you calculate market returns, it's really important to understand that even though the market goes up an average of 10% a year, actually earning 10% in a year, as it turns out, is incredibly rare. Like as the Wealth of Common Sense blog points out, who I'll link down below in the description, the market has only gone up 8 to 12% in a year, 5 times since 1926. That's it. Or basically, going up 8 to 12% in a year is just as likely to happen statistically as the market going up 40% in a year. Not to mention, even more absurd is that only 18% of returns have been between 5 to 15% in any given year, and it's more common to see double-digit gains or losses in a single year than it is to get the average. That's why it's really important that if you're investing, you need to have an outlook of decades, not just weeks, months, or years. And when you look at a rolling 30-year period of the S&P 500, since 1926, the best return was an average of 13.6%, while the worst was an 8% return from 1929 to 1958. Of course, there is no guarantee we'll continue to see these types of returns in the future, and there's always a chance we could have another great melt-up because the United States is printing so much money that this time is different, but that's why there's another solution for anyone who's worried about another crash or an AI bubble or just the market continuing to go higher. And this is what's called the all-weather portfolio. Now, the reason I bring this up is because during a time when investors are worried about a market bubble or an impending crash or rising prices or insiders selling off their stock in record numbers, it's important that you pick a strategy that's best suited for what you're able to handle. And this one's quite interesting. This was created by the billionaire changing world order predictor Ray Dalio, who on the surface has seemingly become very correct in his assessment that the US dollar might be headed towards an inevitable downfall. So he created a portfolio that was able to withstand whatever you throw its way, while still being profitable. See, his theory is that we have 4 major cycles throughout our economy. We have rising prices with inflation, falling prices with deflation, rising growth with the bull market, falling growth with the bear market, and in each of these 4 quadrants, there's a best performing asset that's going to go up while everything else is going down. Like in this case, we have a mixture of stocks, equities, bonds, and commodities. Stocks perform the best when the market's rising. Commodities do well when inflation goes higher. And bonds are supposed to take care of the rest when everything else falls. Since high growth is usually a lot more common throughout history than high inflation, this is weighted in such a way that you can take advantage of what's most likely going to happen in the near future, which is that stocks just keep going higher. So if you're curious how something like this is performed and how much money you could potentially make by investing in it, here's where things get really interesting. But before we go into that, as most of you know, I do a lot of research to put these videos off to know, and that what they all use to found like money, what about and even analytic categories and track key information down below in the as a bonus when you fill of 6 much all weather performed the S&P 500 by 25%. And from 2006 to 2018, it also delivered above average returns while at the same time protecting your downside.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI.
How is this possible? Well, because it was meant to last through all weather and ongoing government shutdowns, volatility was pretty much non-existent. Or in other words, instead of seeing huge price increases and decreases, it just cruised along every single year as normal. For example, in 2009, when the S&P 500 fell 50%, the all-weather portfolio only fell 17%. So if it's performed so well and there's almost no volatility whatsoever, why isn't it more popular? And what's the catch? Well, here's the reality. With any fund out there, it's very easy to selectively pick dates that work with whatever narrative you're trying to get across, like conveniently starting this right before the 2006 stock market crash. But if you go back to the mid-1990s, you could see that Ray Dalio's portfolio earned a total of 758% during a time when the S&P 500 increased a whopping 970%. And even more recently, in 2024, this portfolio went up 11.4% against the S&P 500 to 23.3%. Or basically, even though you limit your downside and in long stretches of volatility, this portfolio does incredibly well, When the market is rising, your upside is also capped just as much, and therefore, you end up making a little less money. But then again, let's be real. This portfolio did do incredibly well from 2005 to 2020, and it made some people a lot of money. So what happened, and is it still good to follow this in 2026? Well, here's the truth. First, for the last 40 years, and especially for the last 5 years, bond yields have done nothing but go down, and that makes up a significant part of this portfolio. Like, for those unaware, a bond is really no different than giving an IOU, where you lend a city, a state, a government your money, and they promise to pay you back with interest. However, with interest rates consistently decreasing back down to nothing, bond yields have declined to record lows, meaning you as an investor are now getting paid back a lot less money, and that means a significant part of your portfolio is not keeping pace with inflation, or even going down in value. Second, also for the last 30 years, I know this is not popular to say, but gold has really not kept up with what the S&P 500 and stock market has been doing. I mean, sure, this last year has been exceptional for gold, and it really proves that there's an argument for holding a decent chunk in your portfolio. But over the long run, the S&P 500 still tends to come out ahead. However, there is one exception to this, and that would be the all-weather portfolio with Bitcoin. Now, even though we don't have multiple decades worth of data compared to something like gold, it was found that just a 2% allocation to Bitcoin has been shown to have increased your overall returns to 16.86%. And even though, yes, starting in 2011 was a bit unfair of an advantage because very few people were buying it back then, it was still found that buying any Bitcoin yielded, so far, pretty positive returns. For example, Bitwise found that a holding period of more than 2 years has had a positive return on overall performance, and just a 2.5% allocation would have boosted your return by nearly 150% over the last 10 years without adding much risk. Fidelity also came to the same conclusion in that a small allocation to Bitcoin ended up boosting performance by a lot without really increasing volatility. Of course, a lot of these have only been backtested for the last 10 years, and it's heavily skewed towards Bitcoin's early days, seeing triple-digit growth. But even more recently, a dollar cost average approach would have yielded some pretty significant profits. So in terms of my own thoughts, what you could do with this information, and how to hopefully have a very profitable 2026, here's what I think. First, you probably shouldn't be investing with a short-term outlook. Even if we are in a massive AI bubble, all the research has shown that stock market returns are never average until you look at it from a multi-decade perspective. Because of that, short-term movements are completely unpredictable and completely outside of your control, and it's more important instead just to stick with the plan, keep buying long-term, and carry on as usual.
Build a website you love with Wix. For your words?
Second, you shouldn't invest too much without diversifying. Of course, I understand. It's easy to want to YOLO everything you have into Fartcoin and Tesla with the expectations of making a few 1,000% return. But you have to understand that the more likely you are to make money, the more likely you are to also lose it. Plus, as I mentioned earlier, individual stock picking is almost impossible over a period of 15 years. So it's probably better instead to take a more balanced approach. Third, do not blindly follow others. I know this seems common sense, but it's not. Anytime you see people driving into one stock, asset class, or company, you have to take a step back and do the research yourself to make sure you're not getting caught up in the hype. From my experience, really the best investments out there tend to also be the safest and the most boring, and a lot of people overlook them because they want the fast money now. But instead, those safe and boring investments long-term end up usually making you the most money. Fourth, along that same train of thought, for the millionth time I've said it, you shouldn't time the market. The reality is, statistically, you are 66% more likely to make more money investing your money right now today than you are waiting. And all the studies show that long-term, the safest, best approach is simply to keep buying in on a regular basis throughout a diversified group of funds, and that's it. Not to mention, anytime you time the market, you have to be right twice. Once when you sell, and then again when you buy back in, and the chance of getting those both correctly is pretty much non-existent. And finally, fifth, you probably shouldn't be investing if you can't handle your emotions. Personally, the only way to remain completely neutral is to have full faith in your investments, and that if they drop, you're not going to be affected by it, and it doesn't really matter because you're not planning to use the money or sell it anyway. From my experience, after speaking with hundreds of people at this point, if you're losing sleep, if you can't concentrate, and you're worried about a 20% drop, chances are you're investing too much, you're making too risky investments, and you should take a step back so that you can make objective, neutral decisions. This way, hopefully you could hold through long term until there's a recovery, or the market just keeps going up higher because they just keep printing more money. That's why, in terms of what I think, 2026 is not about avoiding the stock market entirely, but it's about recognizing the environment that we're in and planning accordingly. Like, we could very well see these valuations continue to decline as investors sell off and take risk off the table, or we could see the market surge in growth as the Fed continues to lower interest rates and print a lot more money, especially with trillions worth of cash sitting on the sidelines. Really, either scenario could wind up taking place, which is why it's more effective to diversify into different investments like stocks, crypto, gold, treasuries, and so on, than try to predict what's going to happen next. The way I see it, the people who really come out ahead in 2026 profitable are not the ones who are chasing the latest headline, but instead the people who just keep buying, are properly diversified, and really just look at the math instead of having their emotions take over. So whether we get a correction, a crash, or another year of unprecedented growth, the smartest move is to stay consistent, stay diversified, and prepare for every what if. Because in the markets, the only real mistake is assuming you know what's going to happen next. Like me asking you to hit the like button and subscribe if you haven't done that already. So with that said,
okay, that was Graham Stephan. Obviously, like he always does, playing the conservative game. Yeah, like most of his videos are really just the same thing over and over again. In the long term, is exactly that's what's gonna happen. Like, if you invest, you're gonna do just fine. But if you're gonna be thinking about the short term, you just never know where the stock market is actually gonna go. And essentially it's impossible to kind of know where it's gonna go at all. But if you think if we zoom out and we look at Bitcoin like on a monthly trend, and we go back to 2018, Bitcoin was sitting at $258 or so here. So let's say 100. What is this price? $159, let's say. In the long term, you're always a winner. And once again, Bitcoin comes down, goes all the way to almost 4,000. Oh, this is Ethereum, not Bitcoin. Let's go look at Bitcoin. So we're looking at Bitcoin here in 2018, 17. Bitcoin sitting at 1,400. Then it goes, by 4 years later, maybe 5 years later, it goes to 64. You're excited, and then it comes back down to 17,000. And you freak out and you sell off. And then you don't know when to get in, you don't know when to get out. But then a couple years later again, about 3 years later, we're back up to 60, we're shooting 70. You're excited and it starts dumping a little bit, you get out. And then Bitcoin continues to go up in value and then comes back down. So it's hard to know where it's going to go in the short term. Especially like, let's say this is the view you had. This is all you know about. This is the historical chart of Bitcoin. It's hard to know, okay, where are we gonna go? Is it gonna go lower? Is it gonna go up? You just don't really know. Even if you had this, you might think, oh, this is so much. I bought it at 6,000 and it's at 28,000, maybe it was 29. I should get out. Well, you get out and you miss the almost $70,000 move. And then it comes down, you might be like, oh, see, I told you. But then again, it shoots back up, right? So this is kind of the situation, because you never know what's going to happen, and especially in crypto, it is just like a recession every single, it's a recession every quarter, every month, or every other month. And there's significant amount of volatility. So it seems like the better play is to just stay really long. Just DCA over the long term, you seem to always win. And like historically, Bitcoin and crypto didn't really have any kind of regulatory guidelines. governments really were kind of saying, you know what, this is scam. This is a way that cartels use the money. 1,000 ways of saying that people use crypto for illicit activities. So my problem with that is, I wouldn't. You're gonna have different companies, different governments, kind of just saying, you know what, it's time to buy it. Like, gonna have different stance. It's okay to buy. It's not okay to buy. But at the end of the day, this administration is kind of writing up the rules and the regulations around it. And the next administration is not going to just be able to just yank a lot of that stuff back, because you're going to have people within the federal government, people within the SEC that are, and also you're going to see institutional companies that have already done the investment into blockchain technology. And so what's going to happen if the government says you can't use cryptocurrencies anymore? Are they going to, and then are institutions going to stop innovating using blockchain? Are they going to stop using link chain? Companies like, it's not even here, but let's see, my analysis, we're still here. I have my, link chain. Let me find my analysis. So link chain, as you can see, is partnered up with some of the largest institutions. Are they going to just stop using crypto? I doubt it. So that's why some of the reasons that I think we are in the long term going to become integrated. Crypto is going to become integrated into the traditional finance from the blockchain world, where they kind of say, crypto is used for illicit activities. I think NVIDIA's earnings is going to be really important, so we might want to see this video from Jose. While we watch that video, I'm going to pull up one of the other stocks that I really am interested in, and right now it's kind of getting beat up.
My skin was tight,
on Wednesday, and the market is hoping that Jensen and Nvidia pretty much saved the AI market. Now, in today's episode, what I want to do is share my overall thoughts in the current AI ecosystem drawdown that we are seeing, and also we're going to look at what the market is expecting for earnings this Wednesday. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotion.
All right, so like I mentioned, NVIDIA is reporting earnings this Wednesday, and this has become kind of like the Super Bowl of AI. I do believe recently, though, NVIDIA has been pretty... We get a lot of what's expected ahead of time. As we're going to see, we already have a lot of announcements that, in my opinion, I don't know if NVIDIA can actually save the market. Now, does this mean I'm bearish in AI stocks? I'm extremely bullish, and as we're going to see, nothing has changed for AI companies, especially the AI companies that I own, where the bullish thesis and the bullish long-term opportunity is still there. The biggest thing that has changed, in my opinion, has been just the stock price itself. And obviously with the stock price, you can go with the trend, the market sentiment, and all that, and that can continue, right? You can continue to see that negative sentiment. But for me as a long-term investor, if I was one that just flips with the stock price, NVIDIA would not be the multi-bagger it is in my portfolio, right? So for me, I have had the experience where usually my gut feeling is right. It's not always right, but sometimes it's right. And I believe the AI market is still very much in early innings. So when I say I don't believe NVIDIA can save the market, I don't mean that the market needs to be safe. It's more the market sentiment. Already, NVIDIA has announced a lot of great updates in just the past few weeks. We're going to look at them. And unless NVIDIA gives us some crazy news in this upcoming earnings, which I personally am not expecting, but I would gladly welcome, unless they give us some crazy guidance that not even the most bullish investors, and some bullish investors and analysts out there have some crazy numbers. Unless they give us something like that, I don't think the sentiment for AI stocks will change just yet. But like I mentioned on the top level overview, I'm sleeping fine just at night. I hope everybody is too, because I believe the long-term thesis for the AI market is still intact. And this is probably the easiest indication for me. I mean, we're looking at capital expenditure here in the most recent quarter, and we're looking at 6 companies: Meta, Amazon, Microsoft, Google, CoreWeave, and Nebius. And you can just tell the increasement of CapEx, the growth of CapEx continues to increase. Last quarter, or this most recent quarter, it was about $101 billion from those 6 players. And there's a lot of other AI companies that I easily could have mentioned here and made this number even bigger and bigger. And that was up from $90 billion the quarter before and about $76 billion the past 2 quarters. So you have seen a massive growth. And this massive growth is definitely thanks to NVIDIA's Blackwell solution, the GB200 and the GB300. We've heard from NVIDIA that one of the reasons, or maybe it's next, one of the reasons gross margins took a hit here from and it started to go into the low 70s. This was because of China restrictions. But the main reason NVIDIA saw a decline in the Blackwell margins was because they were just spending so much in inventory, because they had such crazy demands, and just the ramp-up process for those major orders was impacting gross margins. And as we do know, NVIDIA has guided gross margins to continue to grow and go back to the mid 70s by the end of this year. And I do believe we're going to see that this quarter. We have this past quarter was 72.5. They guided for 73 point something for this upcoming quarter that they're about to report. And I'm going to guess for quarter 4, we're also going to see somewhere in the mid, maybe closer to 74, which is closer to the mid 70s, right? So to me, NVIDIA is just continuing to outsell. The final thing here, if we look at capital expenditure, is all these players have mentioned they're going to increase CapEx next year. So what AI story has been broken? What AI bubble is there? Obviously, some people might be talking about CoreWeave with that, but CoreWeave also is the one with the largest amounts of GPUs. And GPUs are roughly 80% of CapEx. So I'm not trying to make it seem bearish, but if you are in other neo cloud providers because you think they have better balance sheets, that's going to change if they ever get to the type of active power that CoreWeave has. So to me, this market, nothing has changed from my perspective, and I just wanted to kind of give that before kind of looking at some of the overall numbers. Now, another great chart, and all these great charts you can find at fiscal.ai/Jose for 15% off. Data center revenue continues to grow, 41 billion, and this is growing even without the China market. For this quarter 3 that we're going to see, this number is expected to be closer to 48, maybe even closer to 50 billion for the quarter. And again, that is excluding the China market, and the demand continues to grow. Now, we talked about gross margins already, but we are going to see gross margins kind of saw a dive. That 60.5, in my opinion, is a fake number. It's due to write-offs that they had to do due to the Chinese restrictions, or the chips that they couldn't send to China, and they had to write off some inventory. But we are going to go back to the mid-70s, just like NVIDIA's management promised a few quarters ago. The final thing I want to look here is inventories. Inventories has grown dramatically for NVIDIA. Again, kind of just showcasing that Blackwell ramp process of the Blackwell Ultra, the GB300, the B300, and there's still strong demand for the B200 and the GB200 as well. Next company is a massive cash flow machine. Total cash and cash equivalents around 56 billion. This is after massive buybacks that unfortunately I didn't put on the charts here. Free cash flow 13 billion last quarter, and that's because they paid about $8 to $9 billion in tax. If not, it would have been closer to $20 billion. And capital expenditure, very capital light, $1.9 billion. Now, I'm not saying there is an AI bubble, but if there was, I would honestly believe that NVIDIA would throw some free bags here and there to some of the AI companies that they need to continue to survive, right? So with random deals or stuff like that. But as long as this company has this massive amount of free cash flow, it is, in my opinion, the last defense wall that needs to be broken before I can finally say, yes, look, AI bubble is pretty scary for at least the companies that I own. Obviously, there's a lot of AI growth stocks out there and other companies that I might not be too excited about. I can't really kind of discuss on those, but the ones that I own, I'm pretty much excited for the long-term potential.
Are you researching dental implants?
There's a lot of dental offices that'll talk about doing their teeth.
Now, the market continues to grow bigger, right? And we're going to look at their earnings expectations in a bit, but I want to showcase some recent updates as well. Market continues to grow, right? We see Jeff Bezos has created a new AI startup where he will be co-CEO, Project Prometheus, and has received over $6.2 billion in funding. Think of it of another AI lab here created by another multi-billionaire. And this is, in my opinion, going to be another customer that's going to be driving demand, is going to be pushing this AI race to get heavier and heavier, right? Because if you still have all these players that are in this AI race, you're going to continue to buy plenty and plenty of AI chips. We also saw Microsoft recently announced that they continue to go into building their own kind of major AI lab startup to break away from OpenAI as well. So you continue to see more players with a lot of money continue to invest in CapEx via engineers, via AI experts, via GPUs. So to me, that's also another great indication of the market right now. Now, I also want to take a quick highlights of some recent news that happened today. So NVIDIA and a lot of companies are in SC 2025, Supercomputing 2025, which is kind of a developer conference. We did get a lot of cool updates. Some updates weren't like new products, but just updates to old products. But I thought this one was pretty cool. So ARM Neoverse platform integrates NVIDIA NVLink Fusion to accelerate AI data center adoption. Now, this is actually, in my opinion, a great thing for NVLink Fusion. For those that are not familiar with NVLink Fusion, NVIDIA is now allowing to license its network solutions where you can kind of create a CPU. And actually, let's see if we can find it here. Now, first, let's look at ARM stock. ARM stock really much didn't react to this, but if we look at NVLink Fusion from NVIDIA, they have a better image where you can really see what it really does. But let's read the announcement blog. I think this gives us great indication, a great image. One more here. So building an AI server, you need a lot of different products. You need a CPU, you need a DPU, you need networking solutions, you need so many different concepts. Now, NVIDIA can sell you the whole product, or they can license the stuff and you can build your own CPU and then use their NVLink, which is the special type of bridge to communicate to their Blackwell, to their Rubin, to their Feynman. Or maybe you create your own custom accelerator and you can use it to communicate with their CPU or with some of their other networking or DPU solutions. So ARM obviously licenses a lot of solutions, right? This is the architecture that is used by hyperscalers. Every hyperscaler from AWS, Google, Microsoft, Oracle, and Meta are building an ARM-based CPU. But now, if you go with the ARM-based CPUs, you can write off from their cart, not necessarily, but you can say, hey, look, I actually want to use NVLink Fusion to connect it to a Blackwell GPU or a Hopper GPU or a Feynman GPU or a Rubin GPU. And this overall indicates and can help NVIDIA, one, get that licensing from NVLink Fusion, but two, it can also help them sell a lot more products as well for companies that are designing their own type of chip. And I think the partnership here with ARM is really great, and it does help with long-term tailwind potential. Now, there were some other updates coming in from the SC25. Nothing too crazy in my opinion. They talk about some new models that they opened up for physics simulations, some new solutions to help with Python, integration into GPUs. They talk a little bit about kind of their photonics, infinite band CPO networks. They talked about their DPUs. They talked about how quantum computers are now using their NVLink. I forget how they call it. NVLink. Let me look for it really quick. NVQLink, which is what I just talked about before quantum chips. So a lot of small updates here. I don't think anything outside the ARM was anything crucial for right now, but all of these are great indications of NVIDIA continuing to invest in becoming a better company and all create that roadmap for this company to continue to win. Now, I want to jump into the Q3 preview. So hopefully you guys are enjoying the episode so far. Let's just go into Q3 fiscal year earnings preview. Now, if you made it this far, I appreciate if you can hit the subscribe button, the thumbs up. I'm trying to hit 85,000 subs by the end of the year. We're only at 81,000. I'm not sure if we can do it, but I still have hope, right? You get free daily videos here. You have coverage on popular AI and semiconductor stocks. Now, if you want to join the community with deep dives on semiconductor and AI stocks, not even popular, it could be any company, make sure to check out What the Chip Happened. I put episode slides. We have monthly Q&A sessions, community of serious investors, and like I mentioned, a lot of deep dives and a lot of great information is there at a great price. So check out whatthechiphappened.com if you want to increase your knowledge in the semiconductor and AI industry, and if you are serious about that market for sure. We have over 100 plus members already. The community is something I am super excited about. Now, if we look at expectations, so expectations for this quarter, the revenue consensus is around $54.6 billion. On the top end, we're getting even closer to 58 billion, some very bullish. Earnings per share, $1.24, and we see gross margin 73.5. Now, all of these would be an improvement. Revenue would be a 15 to 17% quarter-over-quarter growth, or 55 to 57% year-over-year growth on that consensus. Earnings per share would be 17 to 20% quarter-over-quarter growth, and 52 to 56% year-over-year growth. So they're not the triple digits, but who cares? This is a massive company with hundreds of billions of trailing 12 months revenue, still growing at these massive double digits. I am super excited. In my opinion, NVIDIA is still the GOAT. Now, revenue for Q4 guidance. Now, this is what we want. Guidance right now, consensus are expected to be somewhere around $61 to $62 billion. Now, the bullish models are actually looking at maybe closer to 63 to 64 billion. If we want any excitement in AI stocks after NVIDIA earnings, that's what you want to see. You want to see that bullish model closer to the mid 60 billion in guidance. Data center expected guidance is expected to be closer to 54 to 56. Potential upside with some analysts seeing closer to 58 guidance, and gross margins were expected to kind of go back to those mid guidance for Q4, expecting 74 or 75. So I expect gross margins to definitely be within the consensus. Now, for me, I am expecting closer to $63 billion in Q4 guidance due to the massive order backlog. Now, data center this quarter is expected to be $48 billion. Now, remember, last quarter was $41 billion. So this quarter, $48 billion will be a nice continued sequential growth and pretty exciting. Now, what we're pretty much exciting is just the Blackwell Ultra, right? That is continuing to grow. Now, the other business segments are cool and they could help beat some of these earning revenues. We know from AMD that the consumer market is actually doing really good in forms of CPUs, and obviously for every CPU you need a GPU in some of those laptops, right? So the gaming segment can continue to grow. So there's that tailwind there. Professional visualization can continue to grow with more work happening in kind of workstations, and the automotive market is all expected to grow. Regardless, I do think most of the market is worried about the data center, but any improvements here can definitely help increase free cash flow, can help increase earnings per share, can help kind of make the guidance even more and more juicy. Now, some recent news, some recent bearish news, especially as we saw Peter Thiel and SoftBank exit their position on NVIDIA. I say I could care less. SoftBank sold NVIDIA many years ago, calling the top on it, and now they're divesting it. There's the sentiment shift right now, right? Usually, I never care what these big players do. I just see the overall market and react with what the news that I get and what we heard from earnings calls and other companies. This is intensifying the AI bubble concerns, and I do believe it's creating that bearish sentiment. but nothing I'm following. Now, what I am following is one, the hyperscaler capex boom. Now, that's actual numbers, and it's something that is somebody that's spending money, not somebody that's just selling shares. And second is Jensen revealed during the GTC DC about a $500 billion in cumulative orders of Blackwell and next-gen Rubin through the end of 2026. Now, a lot of people are getting this number mixed up. Many believe it's $500 billion for the next 5 quarters. Many believe it's $500 billion within the next 2 years. I'm actually within the 2 years of this fiscal year and next fiscal year. That's where I'm at. Regardless, both numbers are extremely bullish and still higher than what the consensus was for NVIDIA. Now, we might get even more clarity during the earnings call, but overall, these are still bullish sentiments.
About 20 years ago, Tony Robbins taught Hugh Jackman how to reach the pinnacle of his career. He helped him win a...
Now, key things that we might want to hear about during the earnings, obviously customer mix. We want to see if enterprise and sovereign AI are picking up. Order visibility. What is any update to that? Are there going to be questions towards that? The China market update. Obviously, we haven't heard anything from our government lately, but if there's anything here that we should know about, maybe we hear it during the call. Now, some other questions are just the margins potential. Any maybe discussion on Hopper still, right? Obviously, Hopper is the older generation. We're in the Blackwell era already, but just any update on that? Use cases of AI, and just what are they seeing within the overall AI market, right? Because there's a lot of bearish sentiments right now. So I'm hoping to get a lot more clarity. The market getting more clarity on some of these bearish takes. Like I mentioned, for me, the long-term thesis is still pretty much intact, and I'm pretty sure it's just going to be solidified during this earnings call. So the bull case is beat and raise, and on both Q3 and Q4 guidance. Q4 guidance revenue comes above 62 billion, maybe closer to 63 and 64. A clear confirmation of margins getting to the mid-70s again. The bear case, everything in line, right? Or just a small beat. A small beat is not what we're here for. Just an inline in any Q3 and Q4. Maybe some discussions of weaknesses in demand, which I don't think is the case, but that would be a bearish case, right? But for me, the bull case is more likely the scenario here, and I'm really expecting that guidance to be super, super juicy. So I hope you guys enjoyed the episode. If you have any questions, make sure to check out whatthechip.com.
All right, thank you, Jose. That was a pretty good overview of what's being expected there from NVIDIA coming up. So it looks like we're looking for. It looks like NVIDIA overall since Q4 in 2023, they haven't missed earnings even once. It is going to be a packed day. I think all eyes, the entire market is going to be shut down listening to this earning call, what they say. People are going to be analyzing the numbers pretty clearly. But EPS, they haven't missed. Revenue, they haven't missed for quite a while. So here's their past earnings report. As you can see, revenue and EPS both always come above estimates or guidance. So I don't expect anything less. Once again, I'm really hoping they beat revenue expectations. So going into Q3 2026, 2025, the revenue looking at 54.83 billion, and then earnings per share $1.22. So look at this guidance. So it's gone up significantly here, at least 12 cents, right? 18 cents. Am I wrong? No, 18 cents. From the previous year, that's a significant amount of EPS growth, but also they've increased their revenue estimates as well. So if they don't hit, or they don't have good guidance, if they don't say something about like partnership, the US allowing AMD chips, NVIDIA chips to be sold in China, like something like crazy like that, I think we may see the market just flip to the red side. If they give too much on capex, like they're gonna spend a whole bunch of money, I think that's also gonna cause significant amount of problems. And then if guidance also is down, that's also gonna cause a significant amount of issues in the market for that day. So all eyes on this company is gonna move the whole industry on Wednesday. They're reporting on Wednesday. Most likely earnings will be out by 5 o'clock. And they report after hours as expected. But yeah, investors they care, but they don't really care about anything else being reported. Obviously, Bull is reporting. I think they might actually report really good numbers. Maybe like more users joining the platform. I think this company here is really impressive. It's probably worth taking a look at. Just let's take a look at the max of the stock. Look at this company, up 6,000% since an IPO, I guess. They were at a $2 stock. 6,000% in 5 years. They're up 45%. In 1 year, they're down. Ooh, that might not be a bad pickup. Oh, well, they're down in the short term significantly. They might be a company, to be honest, really to consider. Since after, so this COVID where we were 2019. Let me zoom out a little. So this is COVID 2019. They were a $14 stock. Goes back to $12, and since then they really haven't seen much decline. This company might be worth looking at again. They specifically work with companies around with car. They practically resell cars. A lot of times, what they'll do is if you get in a wreck, they will buy your car. So based in Dallas, Copart operates in online salvage vehicle auctions with operation in 11 countries across North America, Europe, Middle East, so on. 3.5 million transactions annually. The company utilizes a virtual bidding platform, VB3, to connect vehicle sellers with over 750 registered buyers around the world. Buyers primarily consist of vehicle dismantlers, rebuilders, individuals, and used vehicle resellers. About 80% of the Copart vehicle value is supplied by auto insurance companies. Wow, 80% of their cars are supplied by auto insurance companies. Wow, okay. Holding in vehicles deemed total loss. Copart also operates services such as vehicle transportation, storage, title transfer, salvage, vehicle estimations. The company primarily operates on a consignment basis and collects fees based on the vehicle final selling price. Pretty impressive business there, as you can see. When it comes to EPS, when it comes to reporting earnings, this company seems to beat it. I mean, Q4 2024 wasn't that good, but overall they miss and they hit. But overall, they most of the time hit the quarterly earnings. They missed 3 times since Q4 2021, 3 times. But overall, they're always hitting guidance on EPS. Revenue, they hit on guidance pretty well. It looks like they missed a Q3 of 2024. Q3 2024, as you can see, they missed on revenue. They missed on revenue again Q4 2025. Yeah, they missed on revenue Q3 2025, and then they missed on revenue Q4 of 2024. But it is interesting that 80% of the cars come from insurance companies. So, anyways, here's a decent business that might be worth taking a look at. So what I'll do is I'll go Copart IR. Letter to the shareholders. Press release. They really don't have a presentation page. Let's see how this looks. Letter. This is just a letter to shareholders. It's a 2024 letter to stockholders. Who's this? CEO wrote this. This annual letter to stockholders includes forward-looking statements. As we reflect on fiscal year 2024, we're proud of exceptional services and value delivered to our clients and our members. And as a result, continue profitable growth in the delivering to you. We believe that our long-term ownership mindset has been instrumental in our doing so consistently over the years, and will provide a equally essential in ensuring our prosperous future. Okay, that's not what I want to see. Press release. I mean, the thing about used cars, I think it's definitely a Q release first quarter, fourth quarter 2025. Okay, it is like used car sales is a really good business to get into. Dallas, Texas. You all click here to listen. Apply call with this. Ah man, they don't have the PDF. Give me Copart IR quarterly earning PDF. That should exist somewhere. Copart third quarter final results. PDF version of their report. There it is. For 3 months. So this is a company. Yeah, this is actually a terrible way to look at it. Yeah, let's look at here, Copart. So let's see how well they're doing. They have a decent amount of analysts coming into this company and saying it's a buy. They have at least 5 right now. There's some analysts saying, no analysts are saying sell. Maybe just one stepped up in November, but the rest are in the strong buy and hold. They're saying they're about $50, about 21% undervalued from what the 5 analysts are saying right now. But financially, let's just look at the annualized financials. Company growing decently from 2021, but then they kind of just starting to stall here. 10.53, 949, and then 960. So kind of slowing down on growth. If you look at the quarterly, this might show a different number, but so revenue growth year over year, kind of slowing down, as you can see. Overall revenue is kind of in an up to the right trend. Cost of goods sold, of course, that's always going to be up, and then gross profit looking good. General administration kind of going down, as you can see. It's in Q4, the last quarter of Q4. The selling general administration kind of declining there. It's always good to see like companies making more money, but their overall expense is kind of going down. Operating expense overall going down. Operating income kind of all over the place, but overall trajectory like it's really strong. It's not like they don't take any significant hits year over year. Let's look at the net income. This is a company This is a company just hitting net income every single quarter. and actually strong numbers as well. They don't just decline significantly. Net income growth. Net income growth, it is sporadic all over the place, so you never know. But it looks like there is some kind of like a downtrend on the net income growth rate. Also, we noticed that with the revenue growth rate is also going down. Shares, so year over year, it looks like this company used to issue a whole bunch of shares. They slowed down here in 2022, and then they picked up again in 2023. First quarter and Q2 they picked up, and then since since Q1 of 2025, I guess, 2024, they have kind of slowed down in the number of shares that they are issuing. Here it looks like they bought back shares here. Yep, they're kind of slowing down the number of shares they're issuing. I think they're going to have a decent amount of long-term and short-term assets and not too much liabilities here. Unless, so current, yeah, there you go. So current assets, current liabilities, yeah, I mean 3.5 billion in current assets versus liabilities 624 million. I mean, this is night and day. So the company is wow, they have a really good portfolio here. If we're looking at short-term, long-term assets versus long-term liabilities, they're night and day. Very, very, very strong company. So this might be a company, honestly, taking a good look at. Let's see how individuals are reacting to the stock in the marketplace. So Copart stock. Let me move this real quick. All right. Copart stock pushing higher. I really just want to see anything. If you don't understand Copart stock investment thesis, read the book Junk to Gold by founder Will S. Johns. If you're too lazy for that, no worries. Plenty of hourish long podcast summarizing it. Copart. Wow. Average annualized return 20%. After Copart stock dumped 9%, and they possibly lost market share for the first time, we wanted to make this business update. I mean, CPRT. Copart. A lot of it just seems very technical. It worked. Recent example, Copart, 10-year media ROC, earning growth. Sorry. Interesting. Helps me preliminarily evaluate how attractive the stock is. So valuation ratio, key statistics, 10-year median return, ROA, ROE, ROIC, return assets, equity, invested capital, gross profit, EBITDA. This is pretty cool. Compounding that. Copart is 36% below its 52-week high. Peter Kiefer strongly believes Copart is an inherently superior business and it was the only top 10 position he increased in Q3. Good time to buy? This seems like a really interesting company. Terms such as inherently superior are fuzzy, so we will use our holding of Copart as an example to help define the concept. The company thinks in 20-year term, unlike most publicly traded companies who are thinking about the next quarter's earning. Copart made the critical decision decades ago to absorb the short-term pain of buying instead of leasing its locations. Wow. So they have a whole bunch of properties as well. I just bought 8,000. Here's why. After researching for a new place to deploy capital, I found where I want to put it. Copart is one of the most fascinating businesses I've ever studied. From the outside, it might appear dull or industrial. Interesting. At its core, Copart is the world's largest vehicle salvage platform. More especially, it provides plumbing that enables the salvage ecosystem to function, connecting insurance buyers, dismantlers through its massive online auction network. What makes Copart special is the real estate logistical infrastructure it controls. Think of it like a modern-day railroad, just as it would be nearly impossible to recreate railroad's network today. Replacing Copart's network of salvage yards would be nearly impossible. These properties were acquired decades ago, often in areas that would never allow similar development today due to zoning and classic not in my backyard mentality. Copart primarily earns money by selling vehicles on behalf of insurance companies. When insurance companies deemed a total loss on a vehicle, insurance turns the Copart to auction the car. Copart collects a percentage of the sale price plus related service fees, while roughly 80% of the Copart's revenue come from these insurance partners, which is a little scary. The remaining 20% come from fleet operations and rental agencies like Hertz, selling aged vehicles, auto dealers offloading trade-ins, wow, banks and financial institutions selling repossessed cars. Interesting, wow. Charities, government agencies, and private individuals. Competitive landscape, so Copart holds about 55% of the U.S. salvage auction market, compared to IAA's 32%. Wow, on paper, that looks like a close race, but it really is not, because they own a lot of the properties and not leasing them. IAA's fundamental weakness. IAA's fundamental weakness lies in its structure. Unlike Copart, IAA leases much of its land rather than owning it. That means constant rental expenses and exposure to rising lease rate. Oh my goodness. Copart, by contrast, owns almost all of its land outright and carries little to no debt. Yeah, literally. Giving it the durability and cost advantage and ecosystem moat. Technology edge beyond its physical footprint. Copart technological lead is another pillar of its dominance. Copart pioneered online auto auction all the way back in 2003, nearly 2 decades ago, before TIAA went digital during COVID. That early move allowed Copart to land grab online as effectively as it did in the physical world, creating a powerful two-sided marketplace where buyers and sellers constantly achieve better pricing outcome. The result speaks for itself. Over the last decade, Copart had delivered about 20% EPS CAGR and 15% revenue CAGR. Remarkable for a business with such enhancing advantages. Entrenched advantages. Yeah, literally. Growth drivers. So recent results underscore the strength of the core business. U.S. insurance unit volume grew 4.2% year over year. Global insurance unit volume grew 4.5% year over year. These gains are driven by the rising total loss frequencies, TLF. Modern cars are increasingly expensive to repair due to complexity, electronics, and materials. Wow. As repair cost rises, more vehicles are totaled, funneling steady volume of cars to Copart. This trend, combined with the rising use of vehicle prices, acts as both the value tailwind and a natural inflation hedge. Interesting. Because if inflation goes up, then buyers are going to go to Copart and buy used cars. Since Copart earns a percentage of each sale, higher average selling price directly boosts revenue. And then during inflation, price of used cars is obviously going to be a lot more, and people are not going to go buy a brand new car. And in service fees, margins, expansions, and potential buybacks, and sustain 9 to 10% annual revenue growth with 12-15% EPS growth seems achievable. Here are the numbers. Let's look at where Copart trades today. Current free cash flow yield is about 3.14. Historical range about 1.2 to 3.36 over the last 5 years. At a 3-year yield, I see Copart as a fair value, with a strong downside protection given its market dominance and constant growth. Scenario: bearish, base, bull. Bearish, saying $63 by 2030, base 85, and then bull 104. This is a company that is now at $43, so definitely way below the bearish conditions by 2030. Personally, I lean toward the bullish scenario. Copart monopoly-like position, persistent balance sheet, and consistent execution justifies premium valuation. Copart represents a rare combination of low quality and longevity. This isn't financial advice, blah, 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 blah. Damn, this is really good. Actually, this is really good. Copart might be a company worth looking at, to be honest, because Copart doesn't like to do buybacks, but 11% of the company is in cash, no debt. The company has been accumulating cash. It's now at all-time high. So if there's a downturn, this is a company that is well capitalized. They've been a public company for 32 years. 68% of those years have been positive, and the stock has delivered more than 40% annual return in 11 different years. 11% of the company is in cash. The company has no debt. On average, every 25 minutes, someone uploads a YouTube video about Copart. I haven't checked TikTok. What the heck? Good company. He's talking about Copart. That's crazy. People posting YouTube videos. Free cash flow rolling, stability. I mean, that's not bad. Free cash flow number, the growth rate, it is slowing down, but they do have, set over $93 billion. former AIA CEO, on how the rising trend of uninsured vehicles is affecting Copart. I don't view that as a significant headwind to them. I think it will create some noise in the data. Many of those vehicles, even if they don't get totaled by the insurance company, the end consumer is then going to end up selling it to the other body shops who's going to put it through the Copart anyways. Interesting. Well, there you go. If you're interested in a company, check this company out, Copart. Actually, when I wrecked my car, when somebody hit me, I actually ended up going to Copart as well. I just didn't really think about they were publicly traded. And it was such an easy step, easy process. But that is all. Thank you so much for joining me. That is Copart. I'll probably post a full video on Copart on another day, but I'll add Copart as one of the companies that I am doing research on. So there you go. Percentage change, Copart, as you can see, this company held here, but they are getting beat up though. If you look at the stock max, I mean, just doing over 27,000% is crazy. Past 5 years, they're up 45% in the past 5 years. But overall, this whole year when we had all the tech bubble, the tech stocks take off, Copart didn't do too well. You see they're down about 30, almost 30%, 27%. So this may be where the opportunity is. This company does not pay dividend, low beta, so they're not too volatile. So if you look at 1 year, I mean $60 to 45, that's quite volatile. $40 billion market cap. Well, okay. That's it. I hope you enjoyed the video. It's been live for a while. I'm going to be live again tomorrow. I'm going to keep going every single day for maybe a month, and then we'll go from there. All right. Thank you so much for joining me. If you're not subscribed, make sure to subscribe. This is the kind of topic I like covering. Topics around stocks, investments, and finding treasures in the dump, just like this company. All right. Have a great night. Peace.